members, hope you all are doing good and welcome to the blockbuster CP event of ICAI Oman Chapter on personal income tax. As you all know that Oman is growing its taxes year on year. In 2021 VAT was introduced, then from January 25 Pillar 2 is introduced, and now from 2028 Oman personal income tax is introduced. So it's very important for all of us to be updated with all the changes so that we can guide ourselves also to our clients. So with this, I'll welcome our chairman, CA Unmesh Bhome, to give the welcome speech.
Good evening. Good evening. So it starts with a Sanskrit saying, Na chauryaharyam, na rajaharyam, na bhatrubhajyam, na bharakari. Veye krute vardate eva nityam, vidyadhanam sarvadhana pradhanam. So I put the English and the Arabic translation, sir. So ultimately, knowledge is supreme. You can achieve wonders when you have knowledge. And to achieve the knowledge, you need a guru, a teacher, a mentor. And this is our CA fraternity. We had, almost all of us had a wonderful teacher, mentor, late Padma Shri CA T.N. Manoharan sir. He may not have been part of everybody's direct knowledge learning as a part of CA curriculum when they were going through or studying CA, but I'm sure most of you have referred to his books. So he, though not present personally to guide us, he was like having an aura of Dronacharya. That's why I coined the term, he's a modern day Dronacharya for the CAs in India. And we all are Ekalavyas. Without the personal touch of the teacher, we were able to get his teachings and achieve our objective to become a chartered accountant in India. Fortunately, we were able to host him for one event last year, and all the Ekalavyas here were able to pay a tribute to our modern day Dronacharya. So I think we'll be having a 2-minute silence stand once we start with our program to pay homage to CA T.N. Manoharan sir. So that's the tribute paid by salute from all the Ekalavyas of this great teacher. We will be releasing one newsletter shortly, and I'm sure many of us would have some first-hand direct experiences with our T.N. Manoharan sir. So please do share your experiences and let it spread to all the fraternity. There are some unsung stories with him. We'll be happy to share with all the other CA members. With this, His Excellency, Shri Srinivas sir, Dr. Abdullah, Mr. Mustafa, OCCI, board members, past chairpersons, our founder chairman, C. Davis sir, my speakers for the today's event, C. Gaurav Kapoor, C. Asrujit, and all the special guests we have got here, past chairpersons and all my CA friends. Yeah, so just to give an idea to the non-CA members here, ICAI is the world's largest accounting body with more than 1.2 million members plus the students. And to support that, ICAI Oman Chapter is also growing. So I think let's give a big round of applause to ourselves. Sir, it's a 400 plus member community. Many are in the network, but not in the network. Chartered accountants, difficult to milk them. They don't pay fees on time, so we need to follow up with them. So this is our effort to get them back in the community in an organized way. This year, we thought of having one theme linked to the first Sanskrit shloka, knowledge is supreme. So Jnanam Paramam Balam is the theme we have coined for this year, sir. Knowledge is supreme strength, and we have a motto, CAAI, Charting Accountability Through Artificial Intelligence. Just to explain you the logo here, you can see those two red hands, those are the Dhyana Mudra. So when you immerse yourself in learning and you read books, that is the knowledge, the concentration becomes a channel of transformation, and it comes out as a Kalpa Vriksha. So Kalpa Vriksha is a tree which gives you everything you ask. So once you have knowledge, you get everything you ask for. I tried to search for an Arabic word for Kalpa Vriksha, but I could not find it. I think it's mentioned over there. Chhajed al-Haya. It's somewhere near, tree of life, kind, yeah. So as a part of the chapter activities, we do try to give back to the society. So one of the flagship events we have got is on the Omani CFO program under OCCI's support, wherein we train the finance professionals to get that edge over to become a CFO from a junior finance role to the supreme finance role. A CFO is like a quasi CEO. A CEO would not sign anything unless his CFO approves it. So that's where we are trying to empower the local talent. So the program started somewhere in 22, and recently we completed the 5th batch in Sur. So as of now, we have almost trained 200 plus participants. The Sur batch was the biggest batch with almost 72 participants. तो इसी बात पे हो जाए तालियां. So in the meantime, sir, I'll explain you that we have got almost more than 100 plus members who have experience of more than 20 to 25 years. So if you put it together, we are having total experience of almost 2,500 years, which is being channelized to pass on the knowledge to the Omani youth and make them competent enough to become the CFOs of big companies in this wonderful Sultanate of Oman.
Welcome to the journey of empowering financial leadership, the Omani CFO Mentoring Program, a proud initiative of the ICAI Oman Chapter in collaboration with the Oman Chamber of Commerce and Industry, OCCI. Here, inspiration meets expertise to shape the future of finance professionals in Oman. Launched in 2023, this transformative program nurtures the strategic leadership skills of Omani nationals, creating a platform where tomorrow's chief financial officers are shaped today. Under the patronage of His Excellency Sheikh Faisal Abdullah Al Rawaz, and supported by ICAI leadership, this initiative has already made waves by mentoring over 170 aspiring professionals across Salalah, Muscat, Sohar, and Barka. With a meticulously crafted curriculum developed by over 40-plus seasoned experts, the program spans 8 comprehensive modules, from resource management to strategic business planning, offering a holistic approach to financial leadership. Module 1, Knowledge about the company and general understanding. Module 2, Existing financial and accounting system. Module 3, Resource management activity. Module 4, Operation management. Module 5, Funding and its management. Module 6, Budgets and strategic business plans and risk management. Module 7, Revival of SIC units and investment strategy. Module 8, Compliance and legal matters and leadership development. Each session builds essential competencies for navigating the complexities of today's dynamic business landscape. But more than just knowledge, this program is about fostering a mindset for innovation and leadership. At the heart of this success are our dedicated mentors. With decades of expertise, they are the guiding force behind each participant's growth, sharing invaluable industry insights and experiences. Our mission is clear: to cultivate the next generation of financial leaders who will steer Oman's economy towards a prosperous future. With each batch, we witness the transformative power of mentorship and collaboration. As we celebrate the successes of the Salala, Muscat, Sohar, and Barka batches, we look forward to the future, continuing our journey of nurturing talent and driving excellence. The ICAI Oman Chapter, an unwavering partner in Oman's journey towards financial empowerment. Together, we build leaders who not only see numbers but envision possibilities. The future of finance in Oman starts here.
Sir, we did not stop only at training the professionals. We also extended our contribution for the students. So, along with OCCI, launched this student internship program, wherein we created a platform for Omani graduates who are expected to become graduates to undergo trainings at institutions where most of our CA members are in the finance function, or they're in practice in audit or tax or internal audit or consultancy services, where the talent from the Oman universities will be able to join hands with the industry and they get first-hand training. So that's the platform we have created. May we have the video for the student internship program, please?
Welcome to the Students Internship Program, a joint initiative by ICAI Oman Chapter with Oman Chamber of Commerce, OCCI, designed to bridge the gap between aspiring students, connecting them with the best suited opportunity in the country to complete their practical training during their graduation. With this, the universities and colleges in Oman, along with all the potential training houses in Oman, will come on a common platform. Members of ICAI Oman Chapter who work in diverse industries across Oman will also be on this platform as potential internship training providers. This will facilitate ease of identifying the available opportunities for students and business houses and practicing CA firms in Oman to select the right talent. As a university representative, your role is crucial in connecting your students to this opportunity. Here's how you can get started. 1. Log in. Access the portal using the credentials provided to your university and activate the login after registration. 2. Upload student details. Add student names, contact details, and CVs. Make sure all information is accurate and up to date. 3. Confirmation. Double-check the details before submitting. Once uploaded, the students' profiles will be visible to members of ICAI Oman Chapter. That's it. Your students are now one step away to being discovered by top business houses and professionals in Oman. Remember, this initiative is a first-come, first-served model. Once a student is selected, obviously they won't be available for other. Thank you for being a key part of this journey. Together, we're shaping the future of finance professionals.
So after we are helping the Omani talent and the students, we also thought of supporting our fellow members, chartered accountants within the country, outside the country, maybe mostly from India, those who are looking for opportunities in Oman. So we launched this membership placement program as well. So that's for the benefit of a larger audience. You can share the details with your friends back in India or anywhere around the world who are looking out for opportunities in Oman.
Welcome to the Member Placement Program, an innovative platform designed to connect chartered accountant within and outside Oman to explore the job opportunities in Oman. This program is a collaborative effort to bring CAs in Oman and outside of Oman to share their open-to-work status on this innovative platform. And the paid members of the ICAI Oman Chapter will be able to view the CVs posted by these CAs and recruit them for the best suited position available in their organization. Here's how it works. If you are not the paid member of the ICAI Oman Chapter, you would need to register by clicking on the Member Placement Program and fill in your details. If you are already a paid member of ICAI Oman Chapter, then just log into your page and click on Member Placement Program. Update the profile with details, upload your CV and cover letter, and you are ready. Paid members of ICAI Oman Chapter review your profiles, shortlist, and schedule interviews. Once a member's selection is finalized, the status needs to be updated. With this member placement program, we aim to build a bridge between potential and opportunity, paving the way for chartered accountants to explore more and better opportunities. Together, let's shape the future of the chartered accountancy profession. Welcome to the member recruitment program, where talent meets opportunity.
This time, Talia in advance. Huh? So, as a part of educating our members, keeping them updated, sir, we do host multiple events. So, couple of events which are lined up are we are going to have IFRS training program, a 2-day workshop for the members, 15, 16. We'll be announcing the registration link tomorrow, and we might have to go for a limited registration to ensure that the program is very effective. So please do register the moment the links are out. It's going to be at the same venue on 15th and 16th. It's going to be a full day event. And then we are expecting one of the past presidents and one of the Central Council members also to share their experiences and views with the members. Then we're going to have e-invoicing event on the 8th of September, which is going to be effective from 1st Jan next year, right, Jay? July 20. So this is going to be a curtain raiser on how the companies need to adapt to the expected change, though the regulation and details are not yet out. But we learn from the experiences in the region as well as in India. And then the companies are geared up to implement e-invoice. And on 12, 13, and 14 September, 14th is a Sunday. We have almost got the approval from ICAI. We just need to submit some details. So that's also going to be a limited batch. So this program focuses on educating the members on the latest developments in the AI, making them market competitive. And probably we'll be the second overseas branch to host this event. We wanted to be the first, but somehow we became second. But still we can clap for ourselves. Then we're expecting regulations on DMTT, and we'll be hosting the event immediately after that. We also plan to have one regulatory framework event in November. And 3rd December, we are going to have one event on regulation of accounting and auditing profession. That is one of the recent regulations which have been issued by FSA. And there are many more events, but I thought of mentioning only the flagship events, big events, which are likely to be conducted in the next 4 months. Yeah, so one of the important events every year we hold are the international conferences. So in 2022, we did host CA Success Through Synergy in December 22, when CA Sajeev was the chairman. Then next we did hold CA's Beyond Number in Jan 2024, when CA Jim was the chairman. And this January, we did hold CA's On the Edge with under the leadership of our visionary past chairperson, CA Gaurav, who's not looking at me now. So clap for him. So this year we plan to host our international conference much early, most likely in November. And we have coined the theme Vista for the international conference. And I think these slides were already out, so you know what that Vista means, but we'll go through it one by one. So V stands for vision, envisioning future possibilities through strategic thinking, leadership, and long-term impact. I stands for innovation, driving creativity and change through new ideas, models, and breakthroughs. S stands for startup. Now it's the age of startups. So celebrating entrepreneurship, agility, and disruption across emerging sectors. T stands for technology, embracing digital transformation, automation, and cutting-edge tools in finance and beyond. And A stands for, obviously, the artificial intelligence. So one more important announcement we wanted to pass on to our members is that FICCI is holding their 4th flagship event of called Leads on 10th and 11th of September. And we plan to send a big delegation, representatives from the CA fraternity as well. So we will we would want you to register for this event. The links are below. You can also get in touch with our secretary who will guide you, and probably we'll be doing some group bookings for the tickets and the hotel arrangements as well. We'll facilitate that for you. But please join those who can travel to Delhi. It's at Bharat Mandapam on 10th and 11th of September. Yeah, now coming back to the day's topic, which is taxes are the prices we pay for civilization. And today we all have gathered here for the income tax, which is announced in the Sultanate of Oman. We have got two fantastic speakers. We got a wonderful keynote address, and obviously we'll be having an address by His Excellency Srinivas sir as well. Before we move ahead, I thought of having a tax quiz. Who wants to have a tax quiz? There are no prizes, okay? So the first tax quiz is, which civilization is believed to have introduced the first non-income tax? Any guesses? Romans, Egyptians? We have options: Roman Empire, Mesopotamia, ancient Egypt, ancient India. Option D, right answer. Sahi jawab. The next quiz is, which famous historical figure once said, the hardest thing in the world to understand is the income tax? Anybody knows the name of this famous personality by any chance? Yes, sir? Benjamin Franklin? C. Sherlock Holmes. Sherlock Holmes is a fictional character, no? So the right answer is Albert Einstein. The next question is the most difficult question. Which Gulf country was the first to introduce corporate tax in the region? Oman? That turned out to be a very easy question. And that's the right answer. And the final one, you'll all laugh out. May I have the last question, please? What do taxes and marriages have in common? Huh? You can't escape either. All those who agree, please raise your hand. I have raised mine. All of them. Wait. There is a lot of reporting to be done. Now it doesn't mention who has to report to whom. Okay, so the option is not correct. Option C, it is for your own greater good. And everybody is silent now. I can see that you are confused to agree with that. I knew it. I read your mind, that's why I put it here. Option D is all of the above. So which option is correct? Are you sure it's option D? Let's see the right answer. The right answer is ask your spouse. Okay? So the jokes apart, taxes are important decision making in any business, and now personal tax decisions are also associated with that. I'm sure after you listen to these two great individuals, we will do our part as professionals to guide the people around the right message, why it is introduced, what are the implications, what is our role and responsibility. We are, we are I just forgot. We are responsible residents of this Sultanate, and it is our responsibility that we pass on the right message, follow the law, encourage people to follow the law, and ensure that the objectives are achieved. Okay? And to start with, taliyan for ourselves. So there is a story, I named it a story to begin our today's journey. So there was a teacher and a student. So the teacher asked the student to go around the village and ask people that they should pay taxes and get their responses. So the student went to the first villager. He said, you should pay taxes. The first one say, why should I pay taxes? I already pay by waking up early and working hard. I'm sure he must have met a chartered accountant. Then he went to the second one. The second one say, I'll pay, but only if others do so. So probably he met some shrewd businessman that if I am paying it, we better ensure that everybody is paying it. He went to a third person, an elderly person. He said, you should pay taxes. Then the elderly person said, I understand, I agree. This money goes to build bridges, which I may never cross, the roads, which I may never travel, schools I may never enter, but they are for our future, not just for today. So can you guess the type of people the student must have met? Salaried professionals. So the first one is a taxpayer, a normal taxpayer. A second one is the businessman. And the third one is a visionary. He understands the importance of taxes, though they may pinch you in the current generation, but they build the future of the country, of the community. So it is our responsibility to do our part in our generation so that the coming generations are benefited out of it. With this, I will close my speech. But before that, we have a ritual to do, sir. Every speech I do, we have to chant one magical slogan. And that magical slogan was given to us by past President CA Sunil Talati, sir, in January 2025 when he came for the first GCC conference. And those magical words are East or West. Indian Chartered Accountants are
Best.
There are 200 people in this room.
East or West? Indian CAs are?
East or West, Indian CAs are? Thank you very much. With this, I pass it on to Ajay to continue with the day's proceedings. Thank you.
Thank you, Unmesh, for setting the stage. Before we proceed to next speaker's introduction, I'll just ask Sarita ji to play ICAI motto song, and we'll just stand for a minute.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. So now it's time to introduce our chief guest for the day, CA Piyush Chhajed. Can we have the AV, please?
Please welcome CA Piyush Chhajed. With over 25 years of experience, he serves as the senior partner at Chhajed and Doshi Chartered Accountants based in Mumbai. He holds a degree in commerce and a diploma in information systems audit. Piyush is a trusted expert in tax, litigation and advisory services. He has been elected twice to the Central Council of the Institute of Chartered Accountants of India. Within the ICAI, he has served on all three key standing committees: Executive, Examination and Finance, showcasing his broad and insightful understanding of the profession. He currently chairs the Direct Tax Committee and is the Vice Chairman of the Expert Advisory Committee. Internationally, he contributes to top bodies like the ASEAN and SAFA federations. He also serves on the boards of Cello World, Wimplast and Multibase. Please join us in welcoming CA Piyush Chhajed, a leader in finance, governance and community service.
A very good evening to all of you. His Excellency Srinivas ji, the Ambassador, representatives of the Chamber of Commerce, I think Mr. Abdullah, Mr. Mustafa, the chairman of this vibrant chapter of the Institute Oman Chapter, and I should compliment you for such a great activities which has been done, Unmesh ji, and your whole team, I would say, for that matter, technical speakers for the day. All the esteemed members, I would say brand ambassadors of the profession in this part of the country, ladies and gentlemen. Once again, a very good evening. It's my pleasure to be here. Thank you very much, Unmesh ji, for inviting me over here, especially on a very important topic, the role of regulators and chartered accountants, specifically, I'm not talking professionals, in the changing tax landscape. Yes, GCC countries is seeing a lot of changes. But what is the role of regulator and the professionals? When I talk of a regulator, just as, of course, my members are aware, even the Institute of Chartered Accountants of India is a regulator. It's a regulator of accounting and audit profession. It is part of Ministry of Corporate Affairs administratively. And it plays a very important role when it comes to any professional subjects. You may be aware that the new income tax bill it may be passed any point of time. It was introduced in the Parliament of India on 13th of Feb 2025. And since then, the Institute of Chartered Accountants of India was invited by the regulator, that is Ministry of Finance, as well as the Parliament's Select Committee for giving a presentation and the views of the ICAI. Obviously, when they are seeking the views of the ICAI, ICAI represents its members. Just for correction, Udmesh ji, we are today 1.5 million almost, not 1.2. We are the world's largest accounting body, members around 500,000 and 1.1 million students. And when I'm standing here, I'm sure the number would change at any point of time. And so we were invited, obviously when we are invited by the Select Committee of Lok Sabha, seeking our views on the income tax bill, which is going to replace Income Tax Act 1961 with three important objectives, which was to simplify the language, which could be deciphered by the layman, to reduce litigations, and also to make it concise. I was hearing chairman stating that Income Tax Act 1961 is quite bulky. So one of the important objectives of this new Income Tax Act was to reduce it. We were the first one to be invited. Obviously, that is a trust which has been placed on chartered accountants. When they've called the institute, obviously they have called all the chartered accountants. What I am representing as a chairman of Direct Tax Committee before the Select Committee is nothing but the views which have emerged from the professionals, from each individual members. Generally, whatever views which we place before any regulatory body, which is in charge for the taxation, which administers taxation, represents the views of each and every individual members. A chartered accountant plays a very important role in assisting regulators in making the policy. In assisting the regulator, it's actually an interface between a regulator, the tax administrator on the one side, and on the second side, obviously the businessmen, the individual assessees, who are the taxpayers, tax compliances. And in fact, if you go to a speech of our Honorable Prime Minister, Honorable PM Shri Modi ji, he also confirmed that you are the one of the biggest interface between the tax administrator and the taxpayer. That's the important role which we need to play. In this part of the world, obviously, why it is important today? His Excellency asked me also about our motto song, sir. If you see, the Garuda is roaming across the globe. 5 years back, we had a motor song which depicted that Garuda is roaming across India. We changed to it. Why? Today, Institute is present in 47 countries, Oman being one of them. We have around 52 overseas chapters in the 47 countries. We have been represented there. And the professional chartered accountants are assisting not only into accounting and audit, but when it comes to the taxation laws also, whether it may be VAT or whether it's an income tax, maybe corporate or maybe individual or maybe personal, whatever you may name it, the chartered accountants are playing very important role at each and every all of these countries, either as a practitioner or as a consultant or as in the employee or as a CFO in that particular industry. So it's going to play a very important role. Just to take it forward, any new legislation which is brought in by the government of a particular country, I believe it's an important part for a chartered accountant to start working upon that. Like these lectures, what would be coming in the legislation, we should not restrict to that extent that I have to only advise it to my clients. If need be, yes, we should make an adequate representation to the regulators also. I am sure your experience, your feedback would be considered by regulators in any part of the world very positively. And that's where we have to play a proactive role as a chartered accountant. Obviously, when it is ultimately legislated, you would do it. You would help your clients to navigate through it. But that's your part of professional activity. That's what you are here for, and to run your house also for that purpose. But you have to go one step further. That's what I believe a chartered accountant's role is. It's not limited to advising your clients. It is also to advise or represent or make submissions to the government, to the legislature, that how far the tax policies can be effective. Because we do know the very three important principles of when it comes to a taxation, especially income tax. The three important principles, the canons of equity. It is said that the income tax is the only tax which brings out, actually it redistributes the wealth, I would say. Why? If you know what the way I have seen the Oman taxation also today, it's going to be impacted only 1% of high rich net worth individuals or high earners income. Obviously, but the use of those tax amounts would be, the fruits of those infrastructure would be used by everyone. And therefore, the income tax is such a tax which brings an equilibrium amongst the citizens of that particular country. And that's where the important role needs to be played by a chartered accountant. We need to keep in mind the canons of equity, which is very important when it comes to an income tax. Canon of economy. A tax collection cannot be a costly process. In fact, way back again in India, every year Ministry of Finance do consider that. And therefore, if you see, a lot of digitization has taken place across India as far as GST is concerned, which is similar to VAT, or the income tax, so that the human interface is reduced. It becomes easier. You can file your tax return at the click of the button. It's not that you are replacing a professional, because your value addition would be always required, would be always very much valuable for each and every individuals or the corporates. But yes, there should be a canon of economy when it comes to collection of taxes. So the digitization is the most important, I'm sure. When it comes in Oman also, that will be always been considered, and it would be there, the most important thing. Apart from that, as I said, giving suggestions and recommendations. Every year tax legislations keeps on changing. In India, it's an annual exercise. Of course, the new law may come in, but whatever changes are made are done through the budget. When we say it's a finance act for that particular year, which brings in amendment, then those amendments are to keep in line with the objectives of the government, its vision of the government for the next year or maybe the next 5 years in the line. And when this budget comes, we generally, as a chartered accountant, our role starts much before, 6 months before the budget comes in. We prepare our pre-budget memorandum. We give our detailed suggestions to what has happened up till now, what are the changes required to be made into particular legislation, how it will help the assessors with a proper justification. So the chartered accountant's role extend to that levels wherein it's a pre-budget exercise. After budget, again an analysis has been done at the institute level. I'm not talking at an individual professional firm as a professional practice level, but even at the institute level, an analysis of the budget has been done and the presentation has been done. So those are the important areas which I believe regulators as well as a professional chartered accountants has to work in a cohesive manner for any successful tax legislation. Those are the important areas. Coming back to again the institute, evolving role of chartered accountants in guiding taxpayers, obviously, that's why we are over here. We will be discussing personal income tax of Oman in next 2 hours. Obviously, we have the experts over here. It becomes our duty, as rightly mentioned by the chairman, Unmeshji, that yes, it's our duty to guide the assessees to pay correct taxes. Taxes is an important way whereby any particular country is actually able to run its government's budget, government's vision, and therefore, being an interface, it becomes very important for us to advise correctly, see to it that the correct tax has been collected. It should be a correct tax, correct computation of income. It should not be favoring a client or neither of favoring anybody. Nobody should be made to pay wrong taxes also. That becomes our duty also. So that's why we have to be very strong at that part. And the professional chartered accountants, I'm sure, will play a very important role as far as this is concerned. We have the 3 important pillars, sir. In our course curriculum, we have a very important concentration on ethical practices, whether we are doing accounting, audit, or income tax. Chartered accountants are trained to follow ethics, and on an yearly basis, chartered accountants are also expected to revise, review, have a continuous professional education of those ethics so they can actually inculcate those ethical practices in their daily professional life. I'm sure chartered accountants in Oman will play a very important role, will be a professional ethical advisors to each and every institutions when it comes to a taxation. And I'm sure you all will definitely do well in that. For the purposes of equipping our chartered accountants, I'll just give you an example. When UAE came out with an UAE corporate tax last year, the institute was the first of a Dubai, along with its Dubai chapter, to come out with a certificate course on UAE corporate tax, which has helped immensely to all our members to decipher UAE corporate tax, implement it, advise, and help all these stakeholders. We have already done 6 physical batches, training more than 1,400 chartered accountants physically in UAE, and we are also doing a certificate course through an online for UAE corporate tax. My request to the chairman is, you may consider something sort of that. Obviously, institute, the central office in Delhi would be always there for whatever support you require to have such certificate courses, which will ensure that each member is able to go deep dive into those legislations. Of course, this 2 hours will help it will give you a broad outlook about the legislation. But to do a deep dive, we can do such certificate courses the way we have done in Dubai. I think so we can replicate over here, wherein you can cover in depth of the personal taxation. Apart from that, obviously, a regular webinar, so you are doing it, so I'm really amazed, I'm mesmerized of all the programs which you are doing. I'm sure that you will continue with all those programs with that. I would not like to go into the Oman taxation, basically, but I would like to end once again and congratulate and compliment to the brand ambassadors of this profession who are over here, who have got a great name. And because of you chartered accountants who are doing such an ethical practices, providing a professional services, chartered accountants in India has been able to now reach globally. We are trying now to have in various MOUs and arrangements and various other documents. I'll just give you an example. We were just talking of IFRS course wherein in India we have converged. We have not adopted IFRS, but we have our own Indias which we have converged. But we are we are the member body of the IFRS Foundation. I've been the member of IASB. But as far as forensic accounting standards are concerned, so we don't want to leave behind. India is the first country to issue 23 forensic accounting standards. And we have received requests from more than 7 countries as of now, wherein they want that they are ready to pay even the royalty for using those forensic accounting standards. So this is a very important role which chartered accountants are playing. We have to be a proactive, not only respond to a particular legislation. Whatever you think, whatever areas you can think, our curriculum, our new chartered accountants who are coming. I was just addressing today morning, more than 1,000 chartered accountants. There was an orientation program. And believe me, those people have been trained now to all international standards. They are equipped with all international accounting standards also, and I'm sure they would be very useful to each and every country. Of course, Oman, we will be listening to His Excellency also. Oman has been a great help to all the professional chartered accountants. I am sure people have been very happy over here because it's a nil poverty country. It's one of the most richest country, and obviously the professionals have to do well. And all the best to you. Without taking much of time, thank you very much.
Thank you, Piyush. Now it's time to call our next speaker, the energetic past chairperson, CA Gaurav Kapoor. I request CA Badriji to escort CA Gaurav to the stage.
Please welcome CA Gaurav Kapoor. He is a partner at PwC Oman and the immediate past chairperson of the Oman Chapter of ICAI. With over 16 years of post-qualification experience, Gaurav has worked across Big Four firms, multinational companies, and family-run businesses in India, Oman, the UAE, and Canada. A specialist in tax, he brings deep expertise in income tax, VAT, withholding tax, customs, excise, and payroll implementation. He is known not only for his technical skills, but also for leading internal initiatives across tax, legal, and accounting functions, making him both a strategist and a hands-on leader. Early in his career, Gaurav also practiced law, handling civil and criminal cases. He now contributes actively to community life and currently heads the Sports and Cultural Subcommittee of the ICAI Oman Chapter. He believes true leadership means making others better through your presence and ensuring that impact lasts in your absence. Please join me in welcoming CA Gaurav Kapoor, a dynamic leader in tax practice with a passion for service and excellence.
Good evening. His Excellency Srinivas, Ambassador of India to the Sultanate of Oman, Dr. Abdullah, Mustafa Azhar, Board Member, Oman Chamber of Commerce, our immediate first chairperson, C.A. Davis, other past chairpersons present in the room, Central Council Member C.A. Piyush Chhajed, Unmesh Chairman, Vice Chairman Sangeeta ji. Thank you everyone for having me. So before I start, how many of you have read the personal income tax? Can I have with a raise of hands? Quite a lot. So the more challenge is going to come from them. Because those who have not read may not challenge it, but those who have read, it's good that you have read it so we can have better discussion. As you all know, it's only the executive regulations that have been issued. The law is still pending. The law is only issued, the executive regulations are still pending. So bear with me if there are some elements where I have to defer. I have been shared the questions that have been submitted through the app as well as the form. So I will try to answer as much as I can during my presentation. The agendas are there. You need not wait till the end. If you have any questions before, I'm happy to even take as I go along. There could be a different interpretation than what I might say here, but I will give you the logic for my conclusion being reached to that point, and then we can deliberate on that separately as well after the session during dinner. I have a few questions as we go, and you know based on my past presentations that I don't just speak and go away. I want this to be more interactive. I'll try to engage you, so I hope to have your responses as and when I pause and ask for. There are few prizes to be won. Badriji is holding those chocolates. So there's an incentive for you to participate, but decision maker will be me who will get the prize. So don't sit quietly and just listen. These are the topics we will try to cover today. First, let's go to the overview of the Oman Personal Income Tax Law. Not too long, less than 2 months. It was issued on 22nd of June 2025 and published exactly 8 days after on 30th June in the official gazette. It has been mentioned that the executive regulations to the personal income tax law will be issued within 1 year. So you can expect it to be issued by 30th June 2026. It has also been mentioned, and be careful in listening, that a number of other decisions can also be issued, but there is no timeline for that prescribed. So as you know, when the VAT was issued, then the executive regulations was issued, then there was a number of guidance notes from various sector perspective that was issued from time to time. So you can expect to issue some guidances or some decisions outside the executive regulations as well. That power has already been granted through the royal decree. We all know it is expected to start from 1st January 2028. We all know what's the tax rate? So there are many jurisdictions which significantly high tax. Just for a quiz for the members, do you know approximately how many jurisdictions have personal income tax rate of more than 50%, 50? Anyone? Approximately 10 jurisdictions or countries in the world have personal income tax rate of more than 50%, 50. Any guesses? Anyone who can tell me about 5? I hope you are not using the mobile when I ask these questions. So I have kept my mobile here. I don't have a watch also, so that there's no disturbance. So I can expect that from everyone else in the room as well. Okay, what else? France is one right. Canada is not right. Sorry? Australia, no. Netherlands, yes, one Netherlands. So the list I have: Denmark, Netherlands, France, Japan, Austria, Sweden, Finland, Belgium, Ireland, Portugal. And Italy and Germany are not far off. They are around 47, 49% as well. So if you want to add 2 more. So if you consider that and consider the tax rate of 5%, I believe it's too small, right? But with the amount of attendance I'm here seeing, Chairman Sir, I think all are above the threshold of 42,000. Right? So the minimum threshold, which is quite significant, around 42,000 Omani riyals, approximately 110,000 US dollars of income per year, would not be subject to tax. It's only income over and above it that is taxable. Plus, you will have a lot of exemptions, deductions. So let's go on to that. No, 42,000, sir. No. Yes, they changed it, sir. No, standard is 30,000 was for corporate tax before. For personal tax, No, VAT is separate, sir. Yeah, 38,500. But for personal income tax, it is 42,000 Omani riyals per year. A tax on the worldwide income, we'll elaborate more on that. 76 articles. CA Piyush ji was saying about the income tax act being too big, and now the direct tax code is there and we want to refine it. You give it to us in one, I'm sure we will make it as small as 76 articles and we will work it out. 7 categories of income that has been defined. More or less it would cover everything that you can think of to make it taxable for you. And 16 categories of exemptions or costs that are specifically mentioned that will be allowed. You might have seen some videos or articles in the social media. I'm not saying those are incorrect, but there is certain elements that can be further elaborated to make it more clear. I've seen those, and I can assure you that after this you will, and if you have also seen, you will confirm that, some of them are not 100% accurate. So just bear with me on that. Who and what is covered? Most important, right? Natural persons, and of course, the income of the natural persons. So that is the definition ambit of the personal income tax. The most important element of any personal income tax is whether you are resident or you are non-resident. Some countries also, like I know you are all from India, so we also have this resident but not ordinary resident category as well, but we do not have that in Oman. So you will either be resident or non-resident. And very simple rule, we all know about the 183-day rule. Yeah? So if you are present in Oman during a calendar year, they have defined the tax year as calendar year, meaning thereby from 1st January to 31st December, and you are in Oman for more than 183 days, you are a resident of Oman for personal income tax purposes. Other side, if you are not resident, you are non-resident. Less than 183 days or up to 183 days. There are ways how this day and part-time day, if you are coming to Oman and you even are there for 1 minute, 11:59 is the stamp, you get it from the immigration, that day will be counted. So just for, there are always rules for how the days are to be counted. But between these two, resident and non-resident, the most important is what will get taxed. You will get taxed on your worldwide income. Income earned in or outside of Oman. So you earn income through your fixed deposits in India, or you have capital gains in India, or you sold off a property in India, you earn income there, that will get taxed in Oman. Yes, of course, if you have paid tax in India, there will be a credit of that tax. From a double tax treaty perspective, some benefits are there, which my co-speaker will elaborate more on it. I will most likely to focus on the domestic personal income tax only. On the other hand, if you are non-resident, then you will be taxed only if you earn any income from Oman. So, for example, you earn a property in Oman in one of the free zones or one of the ITCs, which allow for foreigners to hold the property. And whether you sell that property or you rent that property and you have income from that, that will still be subject to tax in Oman, even if you are not resident of Oman. Clear? Any questions up to now?
As per the Minister of Manpower or the ROP immigration rule, if somebody stays outside 180 days, 6 months, then the visa gets automatically cancelled. Why did they keep 183 days? One that comes total
182 days, 6 months, they say, yes. No, this has nothing to do with the immigration law and that cancellation of your visa.
But still, there are a number of days you can stay or stay out or stay in. On that basis, people can.
Yeah, you can do the planning. You can, of course, you can say every weekend I go out, so, and then I take 2 months of leave and I don't in Oman for less than 183 days. Yes, you will be treated as non-resident. It does apply to, he will still get taxed on the Oman-based income. Of course, of course. So, irrespective of your nationality, you will be taxed based on the tax residence.
No, if you are Omani and you're living outside.
You will not taxed on income that you earn outside of Oman. You will get taxed on income earned in Oman.
It's not clear. It is not clear if you are Omani, how you must pay, or if you are not residents,
No,
it will
if you
work
are
out. Not
not
living in
not
Oman.
living here, you will not pay tax on the income that you earn outside of Oman.
No,
You
sure.
might be doing jobs, say, in US.
Yeah, sure, clear or
Yes.
no?
As per the
Because
current text of the law, it is clear.
Because somewhere it's not clear. That is why I check. I don't know, I'm not sure.
So,
The current interpretation which I am giving here is based on the unofficial English translation of the law that is available. Obviously, you have to go back and refer to the Arabic version if there is any difference here, right? This I've tried to make it very simple for you to understand how the computation of tax will work. We're not looking at the numbers here, but the overall methodology, because it is very important you follow the same methodology, otherwise there could be misrepresentation from you in terms of compliance. It may not affect your net tax liability, right? So the law first defines is the gross income. Earn from any sources, whether in cash or in kind, right? From that income, then you have to deduct 42,000 Omani riyals. The minimum exemption that has been prescribed under the law. Once you do that, then you come to the net income. Now, each of these elements are important as we go along to understand the other provisions of the law. So please keep this slide in mind when we discuss the future elements or further discuss each of these elements under the law. Once you arrive at the net income part, then you make 3 deductions or adjustments. One is exemptions, one is cost,
and the third and last is the loss.
So you make all these 3 adjustments to your net income to arrive at taxable income, right? So please, try to maintain this sequence. And then you calculate your tax on this taxable income. Of course, we know the tax rate is 5%, so you calculate tax at the rate of 5%. Of course, if you have any income from outside Oman on which you have paid tax, that will also get included in this taxable income, but you will also get the foreign tax credit, but that foreign tax credit cannot be more than the tax liability of that income in Oman. So giving a simple example, if you have a capital gains, say in a jurisdiction where you have paid tax at a rate of 15%, obviously which is higher than the tax rate in Oman, you can claim credit only to the extent of 5% on that income. So you have to match the income and you have to match the rate along with that income. If you have a capital gain from another jurisdiction where the tax rate is say 2%, then you can claim credit only to the extent of 2% and not 5%. So no jurisdiction in the world will give you refund for a tax paid in a foreign country. So take that into consideration that foreign tax credit is limited to the extent of tax applicable on that income within Oman. Yes, sir, please.
Is it the rate or the absolute amount?
Both are driven with each other, isn't it? So, one second. So, if you have earned an income of 10,000 riyals, or I'm just saying riyals because even if it's a foreign income in a different currency, you have to convert to Omani riyals of the rate that is applicable on the last day, published rate by the Central Bank of Oman. So, on that income, you have paid 5,000 tax, right? 50%, right? So, the rate will always get from the amount of tax you have paid. How it is calculated could be even different in different jurisdictions. For example, on that 10,000, you might say first 2,000 it was tax-free, next 2,000 it was 2%, next 5,000 it was 3%. But at the end, you will take a consolidated view of the taxable income, the tax amount, and obviously the rate will come from these two elements. And therefore, if it is more than 5%, you will restrict it to 5%. If it is less than 5%, you will get only to that extent and balance tax you pay in Oman. Yes, sir.
Yeah, so what I was saying is, do we have to really match every head of, item of income with this one? So in the context of India, for example, the Indian income tax is say 30%. So therefore the tax paid is already higher than the tax rate here.
Yeah.
So on an overall basis, we may not be required to pay any tax on that. However, NRE accounts, income is there reported in India, but they are exempt in India. From an overall perspective, maybe we have already paid higher tax, 30% tax if you see on an overall basis. But if I have to match each and every heads of income, like NRE income, whatever is there, I have to report it here, and I have to pay 5% tax in any case because it is exempted.
Yeah.
So is that the interpretation?
Yeah. So the law is saying on the same type of income. So when they defined 11 categories of income, and we'll go to that in the next slide, you have to then look at each of those categories separately. If there is any deviation or anything further clarified, executive regulations might give that detail. But as per the law, it says that on the same category of income level, you have to see
So
it.
the question of category comes here. For example, if the category is a bank, bank balance, for example.
Yeah.
It is comprising of both NRE and NRO.
Yes.
Now, NRO I have already paid 30%. In totality, it may exceed.
Absolutely, I got your point.
Yeah.
I was expecting that question, and as I said in the previous one, you have to take the cumulative of that particular type of income and the cumulative of the tax on that particular type of income. You have earned 2 million Indian rupees, 1 million on NRO, 1 million on NRI. NRI is 0%, NRO is 30% or say 10%. You make a cumulative, what is my cumulative interest income, what is my cumulative tax, and then you calculate the credit of that. Yeah, so I'm not touching upon the tax treaty. As I said, my co-speaker will do that. So I'm just focusing on the provisions as elaborated on the domestic personal income tax. Of course, very important point, tax treaty will play an important role, and I don't want to say more, then my colleague will not have anything to say, so okay. Please excuse me for that. Yeah.
Just to say, yeah, only residents have to bother about the double tax treaty, either place, either in India If he's a resident, then he has to bother. In Oman, he has to bother. Resident has to bother.
Yeah, absolutely. So, yes, please.
So how the taxable income will be calculated? For example, I have a capital gain in India.
Yeah.
So the rules which is applicable in Oman will be applied for the computation for those capital gain?
So if you earn an income in a foreign jurisdiction, you calculate the tax as per the rules of the foreign jurisdiction, and then only the net income is brought to Oman and the net tax payable is brought to Oman for reporting purpose. And
So the gross income which I'm putting in the FIS will be determined based on the income tax in Oman or other sorry.
No, you will add that in the respective head based on the home foreign country jurisdiction.
Okay.
Yeah, I have a question. Whether this gross income need to be calculated based on accrual method or cash method?
Cash method.
Because see, there may be a possibility that individual may have less than 42,000 income, but is receiving bonus amount. So then his income will become more than 42,000. So in that scenario, whether it's a cash or accrual.
So it will get adjusted in the next year. See, the personal income tax, and I mentioned, I think in my starting words, is cash or in kind. I did not set the word accrual. So, and the biggest difference between personal tax and corporate tax is that corporate tax you pay on accruals as well, whereas you do not pay personal tax on accruals. It is, of course, there can be exceptions. I don't want to say there are no, but the normal rule is cash or in kind. That means that you actually receive during that year. A lot of countries have issues of December salary being paid on 1st January. Whether it gets taxed on in the previous year, and there are so many cases across the globe on this particular point. Many companies, we get salary in the last week of the month, so we may not have that issue in Oman. But many countries, you get the salary on 31st or December salary on 1st January. I will defer my full, that 1 month's tax liability to next year. Yes, please, sir. Yes. Not necessarily in that order. I will elaborate on that because there are certain elements of income on which only cost is allowed, and then there are certain elements of income where the exemption will be applicable. So you have to match that. The law does not specify that. The law specifies the costs, so thereby meaning that everything else remains in exemptions.
Right? So,
but I think there is one difference, that you don't get December salary and there is a withholding tax. With the company base, they have to file their tax return, TDS return. It will go to the previous year, not there.
So if the company can also say, I've not paid in December.
No, but usually monthly returns are done.
yeah, so,
Yeah, but there could still be difference between what your TDS might be deducting in the year and you carry forward that for the next year. We have that same situation in yeah.
you cannot escape from government. You are not saving much money. Government is money. Every December is being taxed this year. It means that government's salary.
Okay. So let me say in this word, in a year you might have 13 months of salary to be taxed, and in another year 11 months of salary to be paid. So that could also happen, right? So be mindful of that. So if a company is going in a cash situation where they do not have the ability to pay to the employees and there is 2 months delay, you may not pay in that year and pay it in the next year. So there are a lot of implications. Yes, sir.
Yeah, the gross income means if there is a loss in one head, can we set off?
We'll cover that. So let's move on to, we'll cover that, sir. We'll cover that. So heads of income, let me put all the heads of income. Some of these heads of income we will discuss, not all, but I will still say a few words on each of them. It's just 1 hour that has been granted to me. Oh, I don't. So please let me know when I have 15 minutes left, yeah? So salaries and wages. Salaries and wages includes any kind of benefit in cash or kind that you get. So from an Oman perspective, salaries all get it. Many of you get insurance benefit. That also needs to be converted into equivalent cash and included. If you are getting a house free from the employer, that needs to be accounted for as well. You are getting car, that needs to be accounted for. So anything in cash or benefit will get. I received the questions from the members on end of service and pension. It's not covered under this salary. But it is covered. There is separate head item, so don't worry about it. Self-employment, if you are doing your own business or own work, that is a separate heading that is covered here. You have leasing business, which will cover about leasing of the house property, leasing of the machinery, equipment, etc., etc. You have royalties. The definition of royalties is more or less the same that is already there in the corporate tax law, or that is OECD defined royalty definition. So I'm not going in detail of that. Interest, we all know interest on fixed deposits, interest on bonds, anything on corporate deposit, etc. Everything is covered in this interest. Returns on stocks, shares, bonds, returns, everything is covered. There are some exemptions, we'll cover on that. Yes, sir. Yes. That will also get taxed. Susuk is also covered here in number 6. I may not have mentioned it specifically, but it is covered. Returns on disposal of real estate. So if you are, buying any property and selling, that will also get taxed. Yes, there are a couple of interesting points here. We'll elaborate on that as we go along. Pension and end of service benefits. I said pensions and end of service are not covered under salaries and wages, but there are separate line headings. A lot of questions have come on what about anything that have accrued to you before 1st January 28. The word accrual itself means that it is not yet taxed. So technically, if you receive that after 1st January 28, the whole amount is taxable. But I will just add a caveat that since this is the first time a tax is being introduced in a country, it should be that the executive regulations should give some relief on this aspect. Simultaneously, we are aware of the new labor law and the movement of the end of service benefits from the corporates to the public authority for social insurance. So that can change the scenario as well. So I'm not going in that debate or discussion of how that will happen, but technically, yes, if you receive everything after 1st January 28, it is taxable as it stands from the pure reading of the law. Executive regulations are expected to give some relief. Prizes, so if you won a lottery or Lulu offer or any supermarket offer or a car there, that also needs to be included and pay tax on it. No, we are not in the implementation zone yet. So, sorry. Yes, gifts you get from any event like this as well will get taxable. How to declare as well, sir, first of all. And last but not the least, membership bonuses. So if you are part of Majlis al-Shura or any other similar government body, elected body where you get a specific remuneration. So as board members of OCCI, all that amounts will get taxable, sir. Let's go on to your point that you asked is just covered here, self-employment. So good thing is when you are self-employed, you cannot get fired. But I have highlighted the word not, and it's important. Any reason for highlighting that? Anyone? That's a question from my side.
The income is already taxed in the registered business.
So the word corporate tax is what I wanted to hear. So if you are registered, so Badriji, Nitesh, so if you are registered under a corporate register, you are covered under the corporate income tax. So for personal income tax, they have specifically said anything which you are doing as a self-employed, but you are not registered under the corporate, under the commercial register, you will get covered under the personal income tax. So that's the real logic behind having this provision. Then you have leasing business, and as I said, leasing business will be both equipment as well as house property. Now, costs, right? We talked about cost, exemptions, and losses. So I'm just touching upon cost here. There are only 4 incomes from which cost is allowed as a deduction. And those costs are also defined. 2 of them are these: income from self-employment and income from leasing. Article 11 and 13 provide that rules. There are 2 options, and you have the option to select. Either you take by default, say I'm not going to maintain any books or anything. I'm fine to take just 15% as cost for doing the self-employment or leasing. So you earn 10,000 and you say 15%, 1,500 is my cost, so I just deduct that. But if you think you are actually not earning that much, you are earning much less than that from that particular income, you have the ability to go to actual. But in that case, you have to maintain the books of account, keep all the supporting documents as well. So very important, you have the right to choose, but you need to understand the cost implication on either side, right? What if I have chosen a method and I want to change it next year? So the law allows that, but not every year. So they have said that once a method is chosen, you have to keep that method for at least 3 years. After that, you have the ability to change it. Again, once you change it, you cannot again unchange it next year. You still have to then keep it for next 3 years. So there is a lock-in period of 3 years for a particular method to be chosen. So please keep that in mind while making your decision, not based on 1 year probably. Better is to make a 3-year assessment and then take a decision which option would be more beneficial. So a lot of questions were, please share planning opportunities. So these are all the planning opportunities hidden within these all provisions, right? I said 4 income heads from where cost is deductible, right? 2, we checked the 2 ones. One was leasing and the other was self-employment. The other 2 are income from your real estate, from sale and purchase, and second is from your disposal of shares. So that is not self-employment. If you are owner of a company and you are taking a salary from the company or a remuneration, it will get covered under salaries and wages. Yeah, if you are a taxi driver or you are a YouTuber, so that all will get covered. So cost deductible from disposal of stocks and shares. So very specifically, only 2 types of expenses are allowed from disposal of stock, shares, sukuk and bonds. It is, obviously the first is very, very natural, that the cost of the shares that you have purchased should be allowed as a deduction. And any actual expenses that you can demonstrate was spent, like brokerage fees or any advisory services that you took for making that investment in shares, that all will be deductible costs. And then you pay tax, the gain and loss will be calculated. Yes. Actual expenses on purchase, actual expenses on sale. No indexation in Oman. Nothing, at least in the law. Yes, please.
In the corporate income tax, the capital gains on the MSX listed shares are exempt. So here there is no such exemption.
There is no such exemption in the personal tax. There are some exemptions on government bonds. I will cover that in the exemptions part. But that particular question, yes, there are no exemptions on investments in listed securities for individuals.
No short term and long term also. No short term, long term.
There is no concept of long term, short term in Oman. Flat rate of 5% on all types of income. So very simple tax.
What the law says about the income generated is the sale of digital assets. We are talking about stocks, debentures, bonds and all that. But what about, let's say, if you hold, let's say, digital asset in the form of a cryptocurrency over a stock exchange, which is like a Binance, in a different market altogether, and you generate the income, but you are not transferring that income of a digital asset to an OMR or a USD account in a conventional banking system. So, do we need to really disclose that? If we are not disclosing, is it illegal?
You have earned the income. The word digital asset as such specifically has not been used, but the intention seemed to be it is covered within the stocks, because then some of my friends, not most of them, will say mutual fund word has not been used, right? So you have to go through the intention of the words being used. So they are covering the digital assets taxation as well, so it is taxable. Now whether you declare it, you didn't brought to Oman is not a question. You earned in a foreign country, you calculate the tax as per that, and if you are paying tax, any tax on it, you take the credit. But if you are resident of Oman, you have to declare and disclose in your tax return of Oman.
But let's say if we take an exchange like the Binance, it is actually not coming under any tax jurisdiction actually. So you're paying actually zero tax over there.
That's fine, but you then have to declare and pay tax. If there is 0%, but you still earned an income, which according to the local law is taxable, then you have to pay tax in Oman. They might touch upon on digital assets in executive regulations. I do not know about it, but something to be keep an eye on it.
So that is bound to happen because tokenization is happening even in the real estate as an asset as well.
Yeah, absolutely, absolutely. Okay. Then as I said, the fourth is on disposal of real estate. So again, on real estate expenses, your cost of acquisition is allowed as a deduction. Your expenses incurred on improvement of the real estate is also allowed as a deduction. And then expenses on acquiring and selling of the real estate are also. All standard deductions have been allowed while computing the net gain on disposal of real estate. No, this is just real estate. I'm not talking of exemptions. There are exemptions. Primary residence, secondary. I'm coming to that, sir. I'm coming to that. I'll cover that also. But very important question. I was about to just touch upon that. That why, remember I said, we'll keep that reminder on the first slide, which I talked about, gross income, net income, taxable income. Why it is important? It is exactly for this reason. The cost respective has to be shown below, not on top. So you will not show the last item as your gross income. Your gross income still be actual value of the disposal of the asset. The reason is when I go to 3 slides down, the compliance obligation on the taxpayer, whether resident or non-resident, is if your gross income exceeds 42,000. Very important line. Why it is so? Any answer from the audience? Why they have kept it like this? Why they have said that your compliance obligation starts when your gross income exceeds 42,000. That meaning that all these costs will come below, right? All the exemptions will come below. What's the logical reason? Okay, one element. Anyone else? One at a time, one at a time. There's a chocolate for that, so one at a time. Sorry? Okay, that could be one more reason, but real reason. Absolutely. The complete assessment of whether you are claiming the right costs, whether you are claiming the right exemptions, can be assessed only if they get this information. If you put Chocolate, Badri, chocolate for, for, because if you put the net gain, how will they make assessment whether you have made the right deductions or not? So the real reason is for them to make this assessment. Yes, other elements are there, but the main and the biggest reason is this. Right? Okay, let's go quickly on few of the tax exemptions. As I said, there are 16. I may not touch upon all of them, but let's focus on few of them. So salary allowances, and this is very standard across all the jurisdictions that diplomats and consular missions do not have to pay tax in their home, in the foreign country where they serve as ambassador, sir, or your staff will not have to pay, sir, so you don't need to worry about that. This is important. So let's focus on this. And I will give my interpretation. I know in the market there are 3 or 4 interpretations to it. Maybe there will be some elaboration on this, but I will discuss this and say why I believe it is this at this point of time. Not that after ER issued, I might change my interpretation. So don't, blame me for having this now, but I have a logical reason for it. So one-time tax exemption for a person who becomes resident of Oman for income that he realizes over the next 18 months from the date he became resident. Transition benefit once in a lifetime of that person. If you come to Oman, go back 5 years, come back after 5 years, that exemption is not available. Only one time, right? 2, 3 obvious questions arises here. First, are you all eligible for exemption? Okay. Cash basis. Yes, cash basis. It also depends on your foreign jurisdiction. So if you have declared in that.
Yeah, because see, if we file an income tax return in India, right, we declare based on the accrual, so like FD interest, right? So there is no other option for the Oman tax authority to understand how much cash when they have realized.
See, we will discuss separately on this. I will give you the answer to it. Although we say the word accrual, it is actually already realized because even if you break the fixed deposit after that, that amount of interest is already there. So that is the logic behind that accrual interest being taxed from an India perspective. But it is already due, but not naturally came as a cash, but it's already in there in the fixed deposit quarterly or monthly interest element into it. We'll discuss. I think this is more specific, so we can discuss that. But there's a logic behind doing that in that way. I know if I say no, then I will get a lot of bashing, but I will say no and give my logic to it. Yes, Nitesh.
Gaurav, initially when the law was being promoted, it was at 2 years, and then it became 18 months. What means where the 6 months gap arise? Because all across, even on the social media platforms, it was mentioned by the tax authority itself that 2 years, and then it became 18 months.
I can't comment on that speculation, 2 years or 18 months or whatever. But my point here is one-time exemption. 2027, yeah. Go back and come back. To me, you should still not be eligible for it, but subject to any clarification coming. Second element is when this time kicks off, right? It says 18 months on you becoming tax resident of Oman. Probably you were non-tax resident before and you became tax resident. So the day you land in Oman or any other lane, or after 183 days, or beginning of the year. I gave you one more thought to think about it. So 1st of January, the law became applicable. Someone comes to Oman on 30th of May and he completes 6 months by end of November. So which date to consider? 30th May, 30th November, or 1st January 2028? Exactly. So you might complete 6 months down the line, but once you complete 6 months, you become tax resident for the full year. So the day starts from the beginning of the year. So therefore, it is from 1st January 2028, as per the current interpretation, that he should be considered resident. So any income that he earns between 1st January till next 18 months will be exempt from, one-time exemption from corporate tax in Oman. The second question was, you all are already here. Why you need more time? You are already resident, and there is a provision 1181 base of corporate income tax, which defines the same 183-day rule, under which you are resident. And if you go back to the personal income tax law, only one article has been repealed by PIT of the CIT, which is residence of the individuals. Only one article repealed. Refer Article 4 of the Royal Decree. Only one article which specifically says Article 118 is repealed the day this becomes into picture. So I feel there is a link why they made that and why they said that not to give. I might be wrong, as I said. If something comes up in the future, I will change my interpretation as well. But as it stands, that seems to be the logical reason behind it. Education expenses, I don't have to elaborate more. They have just said that exemption will be given for your amount that you spend on your education for the kids. Or it says ascendants, descendants, and first-degree relatives. But the amount has not been prescribed. So when they prescribe the amount in the executive regulations, that is the limit. You might be getting more from your company, but then it gets restricted to the amount here. Same applies for healthcare expenses. And primary and secondary residence, so I'll just spend 2 minutes here. Primary residence, you get exemption. You have to be resident of Oman. Non-resident doesn't get this exemption. Obviously, that means he's not staying, so he cannot have a primary residence. And once you declare a particular asset as your primary resident, you have to retain that asset for at least 2 years to claim that exemption. If you sell before that, that exemption will not be available. Any medical will be covered, but there will be a limit to it. And then they have also given an option of second or secondary residence. That also will be exempt, but that will be exempt only once in a lifetime of an individual. So 2 exemptions, but there are different categories under each of those exemptions. So mindful of that rules when you make planning accordingly. And since secondary is allowed only one time for one asset, so you need to plan it in a way that where the expectation of return is more, maybe probably put there versus the other. Whereas in primary, you can have number of primary residents, but only the lock-in period of 2 years needs to be maintained. So zakat and donations, but there is a limit that up to 5% of your gross income is only allowed as a exemption. This is important. If you are investing in government bonds, bills or susuk, only interest on that is exempt from tax. So if you put in bank deposit or bonds, it will not be exempt, but if you put in government, it is exempt. So that's an incentive for you to invest in government bonds versus private bonds. Inheritance, wills, grants. So I'm not going in these couple of more details. This is important since these provisions are, there in Indian tax law also, but in a different shape and form. So my only point here is to highlight that Oman also wants its residents to have its own home. So what they have said that any interest that you pay on your first primary resident, that interest will be allowed as a tax exemption. So that's a benefit for having your own house. So if you are Omani and not yet have your house, maybe you wait 2 years to start off that process as well. Okay, if you have income from industrial property rights, so up to 5 years, that exemption has been specifically granted as they want to promote such industrial property rights to be established or registered in Oman as well. Losses, I'll quickly go. As in the corporate income tax, the losses are allowed to be carried forward for 5 years. And as in any other jurisdictions, it is on first in, first house. First loss has to be used first. One more point. on which categories of income losses can happen. All categories, salaries cannot have losses, right? So of the 11 categories, which of them can have losses? One at a time, I will not hear them. Real estate, shares, self-employment, and leasing. So only those 4 categories where we had the costs, that are the only ones where you can have the losses. Others will not have loss. I think you know more or less on this one, and we covered that 42,000 of gross income, if it is exceeding, you have to file the tax return, and we understood the importance of that. But you have to then file within 6 months from the end of the year. Revised return is allowed. Once you discover the error, you have to revise within 30 days, but you have a total period of 3 years when a return can be revised. So you can't have endless time, so they've given a maximum period of 3 years. Interrupted residence. So we all know that at some point of time we might be leaving Oman. So there is a special provision which says that in case you are leaving Oman, you have to file the return 60 days before you leave Oman. So they want to ensure that all taxes are covered. Obviously there is a special exemption also given, and this could apply to local Omanis as well if they are going out of Oman for an employment outside or for marriage, or there could be number of reasons, right? So you have to file the return, but there is an exemption that if the departure is sudden, you have to file before you leave. It could be even 1 day, but that exemption can be provided by the tax authorities on case-to-case basis.
Person is returning to India with the intention to come back.
Yeah, that intention has to be clear on the date of the departure. If you are anticipating definitely that you are just changing the employment and will be back within 1 month, not necessary, but you are going without the intention, having any offer in hand, you then have to settle it out, and then you can revise the return if you come back within that year and you complete. Because it gets linked to the next point also, that if for any year your income is less than 42,000, you don't need to file the return. So you have to file 1 year and declare it, and then that's it.
But gratuity will be mostly taxed.
Yes, that is the reason they said 60 days, right?
But that person has the intention to come back, but he never come back. What happens that?
So that is what I'm saying.
No, he tried to come back, but not materialize. Then also he has to file a return sitting in India?
See, don't worry, the TDS will be deducted. Withholding tax will be deducted by the employer and paid, so there is not likely to be a loss there.
Gaurav, this interrupted resident, most of the places the notice period of employers is 30 days, right? And so how can he file a return 60 days prior to this thing? He would know also that he is being fined.
So that's where it is, that exemption is there. The normal rule is 60 days. However, on cases of sudden departure, as long as you file before you leave is also fine. 1 day before will also work. Who has to file? The taxpayer. If an employee does not have any income other than the salary income from the particular employer, the employer can also file the return on behalf of the employee. That's a special provision that has been provided for. And last but not the least, in case of a deceased taxpayer, the executor of the estate will file the return, again within 6 months of the death of the person. Few other elements, tax assessment has to be completed within 3 years or 5 years. 3 years if you have submitted the return from the date of the submission of the return. So if the return, you have 6 months to file, but you file the return within 2 months, the date from the filing of the return, the 3-year period will start, not from the due date. So early you file, the better it could be. 5 years is in case of fraud or other circumstances. So that's more or less in line with the corporate tax as well. Withholding tax, TDS on salary, full at the full rate of the tax applicable. Whereas if you have non-salary income like interest or capital gains, etc., in case of residents, the tax has to be calculated on 20% of the tax rate, and if your income increase is more than 20,000. However, in case of non-resident, 100% of withholding tax will be deducted and paid. Obviously, all are to safeguard that the tax is already there. If you believe that you have less income and you have some expenses, then obviously you can file the return and claim refund. Record retention, important. Corporate tax, the retention period is 10 years. However, for personal tax, the retention period is only 5 years. Reassessment, assessment, objection, tax abeyance appeals are mostly in line with what is there in the corporate. So there are some changes, but not major enough, so I'm not touching on that. For appeals, it is specifically written, go to the income tax law and all those provisions are applicable. So after the objection and abeyance, it is 100% same. So the same tax grievance committee who now sees the corporate income tax appeals will oversee the appeals under the personal tax also. Then obviously goes to the primary appeal and the Supreme Court. That rules are also applicable. Penal provisions for non-compliances are there, as well as there is a specific provision on the settlement. So the chairman of the tax authority have been given right that if he wishes, he can settle the tax liability and make close the file. It's important, right? It's been given specific power for that. Conversion to OMR on the last day of the year, whatever is not necessarily the 31st December, especially if it is a holiday. So it could be a day or 2 days before also. The last declared conversion rate by the Central Bank of Oman rate should be used to convert your foreign income into the Omani currency and report in OMR. And VAT deductibility, this is mostly will be applicable only if you are self-employed and your income and you are filing the VAT returns as well. So if you are taking the benefit of the credit of the VAT, obviously that cost cannot be allowed as a deduction because it's not a cost for you at all. However, if it is a cost, meaning thereby you are not VAT registered, but you are incurring that cost, then the VAT cost itself will also be deductible. Mostly will be applicable either in leasing or in the case of self-employment. Yes. Gross income. What next? Yeah, start preparing now. 2028 is not far off.
Gaurav?
Yes.
On the tax assessment part of 3 years or 5 years, for expats, how it is going to work? Because the guy already left the Oman. So how the tax assessment part will work for them?
They haven't defined. I'm expecting some more details there. It could be that your tax agent can be the representative. Obviously, there is a provision that you will be given 45 days to make any complete assessment. As in the corporate tax, for expediting the assessment, the provision will be there as well. But the question still remains, there could still be at least 1 year, if not more, when you have already left Oman. But you can still be, because same applies for non-residents, right?
Yeah, yeah.
So
whether it will be binding on the employer, in that case?
No, there is no such a provision that is binding on the employer. Like a non-resident, if he is earning income from Oman, he will still have to pay tax. In the similar way, even a resident after leaving Oman will be required to have the closure of his files. Yeah. So probably the email IDs, the phone numbers has to be captured by the tax authorities as part of the other compliances to target that.
I think return submission will be considered as self-assessment, right?
Yes, so assessment not agreed. So in CIT also, although there is a provision for sample assessment, they do 100% assessment. In personal tax also, there is a provision for doing only sample assessments. But obviously then it is for the tax authority to decide. But yes, provision is there to do only. Otherwise, it's a self-assessment as in many other jurisdictions.
Yeah, thank you. Then the tax period here is the calendar period.
Yes.
If any income outside Oman, that falls in a different, tax period. Say, for example, in India, it's from April to March. So like that, if it is in a different period, how that can be taken care?
You have to calculate, make that 3 months of proportionate adjustment and calculate it.
Okay.
So 3 months of previous year. Yeah, so you are right. Yeah. This is the practical issue that normally India has, and I have same issues because I file in 3 countries. And the India, when I have to declare in another jurisdiction, I have this issue. My wife is Canadian, so she have to file Canada return, which is also again same as calendar year. So every year we need then make that 3 months adjustment and claim the credit of that.
Okay.
So that manual adjustment you have to make, you have to go by the income accrued up to December, the tax deducted up to December. Yes, there could be some ambiguity in terms of the calculation, but you have to do that.
Yeah, right, yeah.
You have to do that, you have to do that.
Okay, thank you.
That's it from my side. I think it's already 5-7 minutes.
Gaurav, one question.
Okay.
When we are mentioning about the TDS from the employers, on the TDS from the employer for the salaries, would the employee will be asked to declare his global income for the deduction purpose, or he'll have to do it separately then?
Not clearly spelled out so.
In the previous slide, you mentioned that the TDS from the employer will be done for the salaries.
Yes, for the salaries it is specifically mentioned.
Yeah, but then if the employee is having a global income as well as the salary income.
I got your point,
yeah,
but it's not specifically mentioned in the law.
Thanks.
Because correspondingly, when they start asking this information, then obviously the tax credit information is also there. You may not have that liability. So that has not been specifically mentioned. Maybe something more comes in the executive regulations. Last question, please. We have to give ample time to the next speaker as well.
Gaurav, one thing is, again, as we said, that tax credit will be as per the tax paid. Now, India has the tax filing in August, generally. So if you are not even filed tax return for the previous year, you have not paid the tax, how will you get the tax credit for?
No.
You don't pay advance tax all the time.
Yeah, so you make an assessment of how much tax is your liability and you pay by June in Oman. I got your point. You're saying India tax return is, say, this year, August.
This year, September.
September, right?
Yeah.
And we don't know what is my tax liability. Yeah. As I said, you still have to make estimation up to 31st December because Oman follows December, not even March. So you have to exclude 3 months. So you have to calculate the previous year's 3 months and then the 9 months.
Gaurav, the question is not about the estimation, because when we are claiming foreign tax credit, we will have to provide a proof that I have paid the tax. Yes. The problem is not about the calculation. Calculation, we will do it on hypothetical basis or on the assumption basis. But when it comes to the credit, tax paid credit, they will ask that, how will I believe that you are paying this tax? So there, the proof will be required, and proof will not come until the tax is filed.
Yeah, you see, the documentation is not required at the time of filing the return. You make the estimation, declare, and you have that, assuming that even in September you will be making that payment. And then when your tax assessment comes in, you give that document at that time. So there is no specific documentation to be submitted at the time of filing the return, and I do not expect it to be as well. But obviously, if you are claiming a credit, there would be a mechanism like we have in CIT also to get that credit done, and I'm sure there will be more elaborated rules on it. But yes, your point understood. But my simple answer is I do not expect any documentation to be provided at the time of filing the return. But subsequently, you need to keep it. Last question, sir. I think I will put under prizes, gifts and prizes. Yeah, the word gambling has not been used. Again, technically speaking, the word gambling itself has not been mentioned, but and we know, in this part of the world, it's illegal anyways. So illegal incomes are never intentionally prescribed in the tax laws. No, unfortunately not. Maybe you can start giving some discount. So challenge for, by the time you become the chairman, you have to reduce the fees by 5%.
Meet His Excellency Godavarthi Venkata Srinivas, India's ambassador to the Sultanate of Oman. an accomplished diplomat with over 30 years of service in the Indian Foreign Service. He holds a bachelor's in electronics engineering and a master's in controls and instrumentation. Since joining the service in September 1993, Ambassador Srinivas has served across the globe, from Mexico, Venezuela, and Cuba to Japan, Brazil, and Hungary. He has held senior positions at India's Ministry of External Affairs, including roles in cyber diplomacy, Eurasia, and Latin America. Before coming to Muscat in March 2025, he served as India's ambassador to Senegal. Ambassador Srinivas brings deep experience, global insight, and a strong commitment to diplomacy. We are honored to welcome him today.
Namaskar, good evening. Let me first acknowledge and thank with gratitude His Majesty the Sultan, under whose benevolent blessings functions of this nature are happening. I have been witnessing such functions, very vibrant, dynamically organized on assorted subjects. Of course, first few weeks have been concentrated on the cultural, social gatherings. But now soon that fun was over. Now we are into hardcore money and how to optimize the income and how to minimize the taxation, the worries. All those things have now been taking the lead. The ICAI Chapter of Oman is doing a wonderful job, presently run by Umesh. He has gotten talent right from Mumbai, who spoke to you. Another expert is waiting. Gaurav has done a tremendous job. The engrossing conversation that I saw here is so interesting on a subject as boring and as money-minded as taxation can attract so much of attention. Really, there's something very, very important here. So, a big round of applause for all of you to listen so intently. Every time we organize any program, any conversation, any interaction, any of the subjects, we invariably ask them, say that, please do ask your questions. So read your papers, the background papers, before you come to the session and ask your questions first. But hardly I ever get any questions. But as Gaurav was mentioning, I think hundreds of questions he received, and he prepared the answers, and he also answered here. So all in all, I must say the subject very wisely chosen, timely, opportune, and obviously the fun of not having to worry about any tax returns year after year is over. And that's what reminds me. I was also like those who are working in Oman, never worried about filling any tax return for the simple reason that whatever I earn has already been deducted, TDS, being a government servant. And if you do not have all these sorts of investment in the stocks, shares, real estate, rentals, etc., there's nothing novel to be added. If you don't bother about taking any tax deduction, no matter you invested in some kind of things which do allow you, then again you are through. So long as I let my salary go to the bank, which is what happens, so I don't have to bother about that. And when abroad, obviously somebody mentioned that we don't have to pay taxes. But I made a big mistake 2 years ago when I began investing in the stock market. So I can no longer escape this entire wrath of having to fill the tax returns, and it's a nightmare. And no wonder, for an exercise as simple as for returning the tax, you need a CA. I mean, that point was made very, very clear to us, that those who want to attempt filling those forms by themselves may certainly wait for a disaster to happen later. So maybe you do require that kind of support. I also was very impressed to see that the ICAI Oman chapter is not only doing their job very diligently, efficiently, professionally, getting good names to themselves, but are also investing in the talent in Oman, that they are having the certification courses. I understand that many of the Omanis are also, they are the ones who are actually participating as students. And therefore, that story of not only being happy about your own success, but to pass on that success, the successful hand with others, is something which you're exhibiting, which is outstanding. So please keep up that good work, add more, just as I think, yeah, right from Mumbai, you have an invitation to add more courses on the lines of UAE. It's a good idea. So all in all, I must say the format has been very engrossing, good. I have learned a lot. I think that if properly curated, any serious program can also attract a lot of attention, interest. Therefore, thank you for that. The last bit is, I remember Davis, who is somewhere absent, maybe out, but Davis Kalucharan is your, the first chairman, as you mentioned, is the one who came to me and mentioned about the entire Oman 2040 vision and connecting it to India's 2047 developed India ambition and connecting the dots, talking from his experience of where are the areas where there are opportunities to further take forward. He talked about the kilometers of the coastal line that Oman has, but the fisheries is underexploited resource and an ambition added to the entire thing, then went on to tourism, mining, etc. A thought came to my mind that if the CA community who actually are into helping the business community here, they are repertoire of great information, a rich knowledge, which can perhaps be deployed, particularly that you do it year after year. As I understand, every year, January, February, you used to organize some kind of international conversation. So there has been an ambition from my side to see whether that can be directed this time to India-Oman. Given that this is the 70th year of India-Oman diplomatic relations, my greed was that can that be somehow aligned towards that. I must really thank them that they readily agreed. Oman Chamber of Commerce and Industry, represented here very ably by both Abdullah and Mustafa, have readily come forward to say that they would certainly bless that which they called Vista 2025. Sometimes in November, I am asking them to advance to October. Let's see what happens. But let me acknowledge this very straightforward. Maybe I am asking too much, because this is something different than what you generally are experts for. This is more like guiding the people. I'm not very clear. I was basically guided by what Davis Kalucharan told me. If that be the truth, if we can bring in your power of connections, the networking, knowing the India story back there, also having known Oman here, if you can connect, that will be certainly a value addition on the lines of, I must say that, certificate courses which are issuing to all the students, which is not your mainstay, but yet you do that. But can you, for some reason, celebrate India-Oman 70 years with that kind of power? So that will be an extremely good value addition, and with that, the last bit of my message to you would be that on 11th and 12th of August, the embassy is organizing online around 13 subjects which we identified. The subjects are essentially viewed around, again, Oman 2040, India 2047, where are we good, where are their ambitions in Oman, vice versa, matching the two. So 13 subjects identified, half an hour crisp sessions, tried to mimic what ICAI did today, that push the entire background material that you can by doing a survey of the open sources so that the background material is available. The major problem otherwise what happens is that people do come to a session and listen to a speaker thinking they have learned great pulse of wisdom, only to learn later that they were cheated because everything that was told was already there in the open sources in any case to begin with. Something which does not match here because you have a law which you have to read in any case. So to do that, we have demystified, we have prepared the background papers, pushed it there, expect people to read and come. The idea to reassure is that those who come, either directly you or through you, your interlocutors, your company, etc., they can read those papers or get them read. The only discussion which we will have when we'll have this half an hour session online, roughly 25 minutes to be very frank, would be exactly focused on where is it that we can add more value. As I say so, I'm also humbled by the fact that the 70 years of the formal diplomatic relations, 200 years of known familial Mandvi to Muscat kind of relationship, and 5,000 years of historical relationship, essentially means that practically everything that was to be done between India and Oman has been done. It's a mature, settled relationship. To add any incremental value to that is absolutely very, very challenging. The challenge is what we have, that's what we are paid for. With the help of the colleagues like you, friends like you, we try to move forward. So I encourage you to have a look at it. It's on the embassy, on our social media Twitter. If you can somehow participate in whichever session is of your interest or your interlocutor's interest, that will be extremely valuable addition. And let me add, without revealing any thunder or stealing any thunder from the future, that we expect that conversation of 11th and 12th of August as also of Vista 2025, if it were to happen. We are keeping our fingers crossed, but if it not happen, so both of them will feed directly into the highest level of discussion and conversation between the two sides. And thus, hopefully, we will all be partners to progress and prosperity in India-Oman relationship in times to come. Thank you very much. Thank you.
Thank you, His Excellency. Now I would request C. Sangeeta ji to facilitate His Excellency.
They were so discreetly giving this lovely piece. Huh? Everybody got silently. I'm sure it was not done because of me, right? All of them got it silently. They sneaked out what was that, but they told me there are seeds which I can grow, right? Thank you very much. Very lovely thought. Thank you.
Be on the stage. I would request all MC members to come on the stage, along with Mr. Piyush. Last but not the least, our next speaker, CA Asrujit Mandal.
Please welcome CA Asrujit Mandal. With over 28 years of experience, he is a seasoned expert in tax, regulatory and deal advisory services. He has held leadership roles at PwC India, KPMG India and BDO, where he led practices across East India, Bangladesh and Nepal. CA Asrujit specializes in corporate and expatriate tax, international tax, VAT, transfer pricing and cross-border transactions. He has advised clients across manufacturing, EPC, mining, FMCG, telecom and retail sectors. He holds a commerce degree, is a chartered accountant and has a postgraduate diploma from IIM Calcutta. From tax treaty interpretation to litigation and regulatory structuring, he brings unmatched depth in both Indian and international tax landscapes. Currently, he serves as Regional Tax Partner at BDO. Please welcome CA Asrujit Mandal, a trusted voice in global tax advisory.
So a very all of you, members of the Institute, a very good evening to all of you, and thanks the Muscat chapter of the Institute of Chartered Accountants for giving me this opportunity. Can I just have a hand? So I think a lot of it has been covered, and so what we are going to talk about are the residual provisions. We are going to talk about the DTAA between India and Oman, prospectively, and we are going to talk about some other residual provisions. But what had happened was the law came in, and we understood that the executive regulations are going to be put to place in about a year's time from the law. We also understand during our consultations with the OTA that the executive regulations are going to be put to public consultation, and also the fact that it's going to be pretty simple. There would be very logical inferences. There are going to be a lot of models being put to place, a lot of evaluation rules are going to be put to place, and that it's going to be easy to comprehend and to comply with. With that, but as we were preparing our analysis of the law that has come sometimes back, the one question which came on time and again, and which actually came in today as well, is the fact that are my Indian incomes going to be taxed? The answer to it is a resounding yes. That's because there are two methods of taxing incomes across the globe. The first is obviously where the source rule, basically. So there are certain jurisdictions which apply the source rule, which means the incomes which get generated in those particular jurisdictions get taxed. Opposed to that, there is something which is called the residence rule, which Oman and India unfortunately follows, which ideally means that if you really become a tax resident of these particular jurisdictions, unfortunately, you are going to be taxed on your worldwide incomes. And this is what I had been told to start with. The slide is pretty understood. And so if, for instance, you are an Indian citizen and you are a tax resident of Oman, what happens is that the income which is earned in Oman is taxable, and unfortunately the income which is earned outside of India, outside of Oman, including India, is also going to be taxable. Of course, the credit mechanisms flow. That's from the Article 25 of the treaty. However, in case you are a non-tax resident in Oman, only the Oman sourced income is going to be taxed in Oman. Let me also introduce very quickly, I'm cognizant of the time, but let me also introduce very quickly the buckets that we discussed, the ROR, RNRORs, and the non-residents. So these are buckets in which the Indian taxation system works for the purpose of putting to tax the incomes generated. So let's not look at the slide. Let's really try and understand as to what is going to be taxed. For our resident and an ordinary resident, the worldwide income is going to be taxed. For our RNROR, which is a resident and a not ordinary resident, all incomes which are received or deemed to be received, and these are Indian context, so I'll talk about India only, all incomes that are received or deemed to be received in India, accrued or deemed to be accrued in India, and arising or deemed to be arising in India are going to be taxed. Along with it, what is going to be taxed are any incomes which is generated from any business which is controlled from within India or a profession which is set up in India. That's our NROR. NR is pretty much the same, so which ideally means the global income doesn't get taxed in the hands of our NR, with the lone exception that in case it emanates out of a business which is controlled from within India or a profession which is set up in India. So we have been talking about incomes received in India, deemed to be received in India, accruing, etc. So here's the definition: income received in India, and these are very important connotations for you to kindly comprehend on, because at some point in time, all of these incomes are, or all of these definitions are going to be handy to determine what sources of income, what kinds of income are going to be you guys are going to be putting to tax in India. So ideally, income received in India is not defined, and it generally refers to income which is earned in, rather received in India by the non-resident or an agent employed by the non-resident. Be mindful of the fact that it's a first-time receipt. Let me explain. So, which if there is an income which you receive back in the UK and then it's remitted back to India, then this is not going to be put up for taxes in India because that has not been received in India. Similarly, income deemed to be received in India, it's pretty much a legal fiction, as Honorable Supreme Court in Keshav Mills had observed. So it basically talks about Section 7, which comprises of the accretion to provident fund balances and central government pension funds. Incomes accruing or arising in India, not too much of a concern there. It talks about the services which are accrued, which are rendered in India, and for the simplicity that it has been rendered in India, it gets accrued or deemed to or arise in India. However, the larger elephant in the room is obviously the income deemed to accrue or arise in India, because it postulates the definition of a business connection. Now, if you really look into Section 9 of the Income Tax Act, you will notice that the biggest, elephant, animal, rhinoceros, whatever you want to call it, is basically this chap here. The business connection actually embraces pretty much the definition of an agency P. However, is wider than that, wider in connotation than that. It includes significant economic presence, which is, pretty much a defining thing for non-residents. And the best is, in case you ever come across a business connection, the best is to probably look at a scenario of an available treaty, if any, and take treaty shelter under a permanent establishment. We can, of course, I'm shrinking this conversation a little because of the time, but we could go on in case somebody is interested. But, however, it's very important to note that what is going to be deemed to accrue or arise in India is any income which is from a business connection in India, or a property in India, or an asset or an income source in India, and this includes transfer of capital assets which are situated in India. Residential status, I'm not going to talk about it much because we are pretty sure all of us knows it. So what is happening here is that the resident and ordinarily the resident, we have our NROR, we have a non-resident, and then there's a fourth variety which talks about deemed residency. We are going to talk about that because that's a killer. Okay. So we are not going to talk about ROR much, but just to mention about the exceptions. Now these are leverages. Remember, this actually is the employment rule and the visit to India rules. Now what happens is, why are these leveraged conditions? Because in that particular year that you leave India for the purposes of your employment, the 60-day that you see, the second bullet of the slide gets increased to 182 days. So these are covered by Section 6 of the Indian Income Tax Act, and the thing that I just said, which is on the third bullet from the top, is enshrined in explanations 1A to Section 6(1) of the Indian Income Tax Act, just in case you want to have a look back at any point in time. So ideally what happens is that, in case you are leaving in India for employment in any particular year, the 60-day goes to 182 days. And in case being outside of India, if you are a person of Indian origin or an Indian citizen, you can come back to India, and then also that particular 60 days becomes 182 days. However, what has happened is, unfortunately, there is a monetary consideration which is now being put to place effective financial year 2021. And it says that in case your Indian income, if you see the words out there, it's if total income excluding foreign income. So which means your Indian income is greater than 15 lakhs. The threshold is, if it's lesser than or equal to 15 lakhs, the threshold remains at 182 days. However, in case if it's greater than 15 lakhs, the threshold reduces to 120 days. So which means that your leverage is lower, which ideally means that you get 60 lesser days to actually get into a scenario of get into a scenario of ROR, which ideally means, as I said, in a ROR scenario, your global income gets taxed. Deemed residency is obviously something which is quite difficult, and this is something which came in FY 2021 as well, which ideally means that in case your Indian incomes are greater than 15 lakhs and you are not taxed anywhere across the globe, this ideally means that your global income, including whatever incomes you have across worldwide, is going to be taxed in India. Non-resident is pretty much that bucket which ideally does not which does not satisfy the basic conditions of residency, which are 182 days, stroke 60 days, stroke 120 days, as the case may be. So what do we learn out of this? What are the key takeaways from this? So obviously the employment year, which is in explanation 1A of section 6(1), provides you with a leverage in as much as that you reach the ROR status a little later, so which means that you can stay back in India for a little more while without being a ROR, in which case your global income gets taxed. So that's a benefit. What we'll do is that we are talking about the employment year that we go across for employment outside of India. Is it only going to be employment? We are going to see in the later side that it's not only employment, it includes self-employment, it includes professional work, it also includes avocations, but then that's in the later slide. For visits to India, just remember that there is a longer threshold of 182 days in case your Indian income is lesser than 15 lakhs. However, if it's equal to 15 lakhs or lesser than 15 lakhs. However, if it's greater than 15 lakhs, that number of days changes to 120 days. Nonetheless, it's better than the 60-day, which is generally the rule for RORs. Employment may not be required to prove, like for instance, we will see in the next slide that you would require to specifically prove that you have left India for employment. In the first case, if you want to take a benefit of 182 days employment here. However, for going back or a visit to India, you don't have to prove anything. It's pretty much self-driven. Deemed residency, you have to be a citizen of India, and as I said, in case your Indian incomes are greater than 15 lakhs and it's not liable to tax in any other country or territory, then you are going to be taxed on a global income. You are deemed as a resident of India, even if you do not follow any of those rules of 182 days, whatever. Even if those rules are not followed, but still you become a resident in India. And to that extent, there is just a thought going around people wherein, in case you are sure of any significant income that's going to be arising in India, whether you should push it back till about 2028 if possible, because by that time you're going to be taxed in Oman. I don't want to talk much about this. This is basically the tiebreaker rule, which is enshrined in the domestic, the DTAA, in case you really have ties between two jurisdictions, both of which are claiming you to be a tax resident of themselves, then you have a tiebreaker rule. However, let me tell you, the India-Oman Treaty, which has just been kind of revamped, there is a revamped protocol which is as late as July 2025, places a large emphasis on the tiebreaker role, and you have to ideally go back to the tax authorities to decide by themselves which country or jurisdiction you belong to, which is basis mutual agreement. Right, this is the employment year, where your 60 days gets increased to 182 days for the purposes of your benefit. So as I was saying, that is it going to be for the purposes of employment only, which is only for the, so is it only the second bucket, which is leave India to exercise employment outside India? The answer to it is no. It's leave India for obtaining employment outside, which means you are in a pursuit of employment. You could be leaving India on deputation to another country, and you could also leave India for self-employment outside India or any of the vacations. Sure. So as I was telling you that the case laws, if you want to really have a look back at some point in time on these provisions, the case laws are also supplied. Therein, O. Abdul Razak, leave India to exercise employment is obviously in the rule, and to that relevant extent, it doesn't need a case law to support this. British Gas India, Aditya V. Birla, sorry, there's a spelling mistake. It's going to be Aditya V. Birla and case Sambasiva Rao. Right. Delhi ITAT has also said that, SSC being a professional golfer, so it's not about employment, it's also about a profession that you can actually render outside of India. Still, you will be eligible for the employment rule. That's Delhi ITAT, Jatinder Singh Randhawa. Supreme Court of India, Aditya V. Birla. It clearly mentions that employment does not really always mean salaried employment, but it also includes self-employed professional work. I would just specifically mentioned about this particular judgment of the Honorable Chennai ITAT, Income Tax Appellate Tribunal in M. Madhavan. So this is a very, very recent case law. Mr. Madhavan happens to be a very reputed restaurateur, and he keeps on visiting various countries in the Asian circuit and also beyond. And our key takeaways from this are basically three. That, as my previous speaker also mentioned, that you need to go across to the Department of Immigration to ideally prove how much of time that you have spent outside or how much time you have spent in India. So that demarcation is only going to be possible through the evidences put forward by the Department of Immigration. That's one. Secondly, you need to clearly prove this employment here. Any travel outside of India, whether on medical grounds or educational grounds or tourism, is not included in this employment year benefit. So this has to be clearly objectivized. The third thing that my personal takeaway on this is they mentioned that they cannot be put to a business purpose objective, that Mr. Madhavan was not on a business purpose objective merely because the fact that he was on a tourist visa. Now, if that were the case, and all of the foreign top-notch executives, expatriates, including Indian expatriates, could have come on tourist visas and still do work, business work, stuff in Oman, for instance, then we'll probably not have a PE scenario or a permanent establishment scenario ever again. So what these expatriates will probably do, they will come on a tourist visa, do work, get back without constituting or even alleged to be constituting a permanent establishment in any jurisdiction.
But he's not on a, you have to prove two things. One, you have to prove you have been outside India. Then you have to prove that you were on a business trip.
No. So what I'm trying to say here is that generally, if you have seen the residency rules, the stay in India, so there's a little time crunch, hence I'm trying to kind of be as fast as possible. So if you really see the resident or ordinarily resident rules, it's either stay in India is greater than 182 days during the course of the year, or stay in India is greater than 60 days during the year, and greater than 365 days in preceding 4 years. Now what happens is these 60 days become 182 days in case in that particular year that you are leaving India, for instance, for the purposes of business or for employment. So ideally, this gives you an extra time from 60 days to 182 days, which does not make you a ROR. And obviously, this is beneficial to you because in the case of ROR, your global income gets taxed. I think we did discuss this, and so now, obviously, the next bit of the leveraged position, which talks about leaving India, vis-a-vis visit to India and return. Remember, we spoke about return to India, in which case the leveraged position of 182 days is possible, provided your income is lesser than 15 lakhs Indian income. Right. So there is this Bangalore Tribunal judgment. So the first question was that assuming this year, assuming for a minute that this is the year that I leave India for an employment. How many times I'm going to get this benefit? Am I going to get this benefit in 2025, or would I get this benefit if every year that I'm going to be outside of India? This benefit of 60 days vis-a-vis 182 days. The Bangalore Tribunal, in case of Manoj Kumar Reddy, has clearly ruled that that year refers to the previous year in which the assessee has left India for the purposes of employment, and no subsequent or succeeding years are possible to be counted for the purposes of this benefit. Citizen of India being outside of India comes on a visit to India in any previous year. You don't have to really, as I said, reason out for this coming into India. CBDT Circular 684 is very clear, which categorically says NRIs might have investments in India, other scenarios in India, and to that extent, in case they come back to India for the purposes of monitoring of these investments, they are not to be questioned. This is a very unique position, AR in Smithanand. Wherein he said, so this was a scenario wherein there was this person who actually comes to India for a visit, goes back to the foreign country, which is the host country in this case, and then resigns in the same year and comes back to India permanently. Now, that beneficial position of 60 days to 182 days is not available because she is not on a visit to India. She was on a visit to India, exhausted her 60 days, went back, and then came back to India permanently, and the benefit under explanation 1B to section 6.1 is not available in this case. Charging provisions. Now, what we are going to talk about is from the perspectives of Oman tax residents. Now, I have considered that each one of us are Oman tax residents, unfortunately or fortunately, whichever, and we are NRIs from an Indian standpoint. What happens in case there are dividends or the charging of incomes with respect to dividends? In India, there is a nil withholding payment on dividends. And to that extent, the DTA rate that the double taxation avoidance agreement between India and Oman prescribes a rate of 12.5%, 10% in case the holding of the shares are greater than 10%. However, this is just about a statistical information because I don't need this because there is a nil withholding on payment of dividends in India domestic tax law. So the domestic tax law of India is better in this context rather than the double taxation avoidance agreement for me as the taxpayer, and to that extent I rely on the domestic tax laws of India. What would ideally happen is, remember, ladies and gentlemen, this is an income which is accruing or arising back in India, correct? So which means that this is going to be taxed in India, correct? So which ideally means that I'm going to have to put this to tax in India at a slab rate. Of course, I'm able to claim if there is a withholding, which is nil in this case. And then because I'm a resident, as I said, I'm a Oman tax resident, this is a global income for me, which is going to be taxed in Oman at the rate of 5%. Of course, I'm able to claim whatever expenses I want to claim, and ideally, the withholding tax deducted, of course, against the tax, is able to be adjusted. And then, of course, when I'm filing in the tax return in Oman, the foreign tax rate, if any, to the extent of the Omani tax due on this particular income is able to be claimed. However, this could, at certain circumstances, be in a refund position. Similarly, with interest, now yes.
No, if you pay tax, more tax in India, what Gaurav explained, you will not be in a refund.
Yes, you cannot be in a refund position merely because you have paid the withholding taxes. But however, what happens is in this, you are able to take a claim of the credit that you have paid tax, on which taxes have been paid in India. However, remember, what has happened is there has been no expenses, which has been taken care of or which has been allowed in India. But however, in Oman, what ideally would happen, you will have expenses to claim. So after you claim this expense, there is a 5%, with I will come to the elimination clauses in about a while. But what I'm trying to say is that, assuming there is a dividend, which is getting taxed in Oman, and there are certain expenses that's there. So you are able to claim those expenses. Those expenses sit on the debit side of are allowable expenses, which gives you a tax shield, and to that extent, there might be a refund. You are not able to get any refund out of a tax that you have paid in a foreign country. That because the maximum that you are able to claim a set off of the foreign tax credit, you will see that is up till the Oman tax on that particular income. Let's talk about the interest position. India levies a 20% WHT on payments of interest. However, there is a DTAA benefit which is available to you at the rate of 10%, provided you are the beneficial owner of this interest. So which ideally means that, the DTL or the domestic tax law talks about a 20%, whereas the DTAA talks about a 10%. You obviously would choose 10%. Obviously, this is going to be put to Indian income tax returns. You pay the incomes on a slab rate, and the rest of it is pretty much similar. You take this, since you're globally taxed in Oman, what you need to do is to put this income to tax in Oman, and then you pay, which is taxable at the rate of 5%. Moving on to royalties. There is the DTL talks about 20%, the DTAA talks about 15% currently, but remember I said that the India-Oman tax treaty has been revamped very, very recently, and effective 1st January 2026, the DTAA rate is going to be 10% instead of 15%. So which means obviously you're going to take 10% benefit after January, currently 15%, and the same rigmarole that you are going to see. I'm just trying to explain the position. The elimination, which is in Article 25, will follow in the next slides. Technical fees, same 20% DTL, DTAA 15, currently 10 at a later point in time, effective 1st January 2026. What happens is, obviously, this is going to be put to Indian tax at the rate of, at the slab rate that India offers, and then all of these incomes are going to be coming into Oman and getting taxed in Oman. Of course, you receive the WHT credit that you have otherwise paid in India, subject to the limit of Omani taxes thereon. Independent personal services, these are professional services or independent activities similar in nature to professional services. I'm carrying forward the same example that the Oman tax resident is rendering services in Oman. It's going to be taxable in Oman and not in India. Ladies and gentlemen, kindly be aware of this. Until and unless there is a fixed base which is akin to a permanent establishment is available regularly to this person who is renditioning services in India, or his stay in India is greater than 183 days, then the incomes from such activities, in case these two conditions are fulfilled, are going to be taxed in India instead of Oman. Otherwise, generally Oman. Similar dependent personal services, the only difference between the two is that dependent personal services talk about employment positions, salaries, wages, similar other remuneration in case of, with respect to employment. You are able to get a short stay exemption, which means that is going to be taxed in Oman and not taxed in India, if the recipient, which is the person who's gone on deputation and enjoying the short stay, the recipient is present in India for lesser than or equal to 183 days, and the employer who pays the salary is not a tax resident of India and neither has a permanent establishment in India, or or a fixed base in India. In these short stay exemptions, of course, we're going to talk about quickly later, but you have to be very mindful of constituting or getting into a risk of constitution of permanent establishments because of the fact that, generally what happens is a fixed plus PE is generally somewhere around 182 days or 183 days. This is 183 days. So in order to design a short stay exemption, there are enough and more situations wherein you have constituted for yourselves fixed plus PE, that is the company in Oman, might constitute a fixed plus PE in India or a service PE in India. However, just be aware that there's no service PE clause in India-Oman treaty, and to that extent you can take leverage of that. Capital gains, favorite. Let's talk about the right-hand side of the slide first because that's easier to do. The India tax resident investing in shares in Oman, it's an India tax resident, remember. So generally this will be governed under Article 15.5 of the treaty, which ideally says that it's going to be taxed in that particular country of which the company which is in which I've made the investment is a resident. Now that particular company is a resident of Oman. To that relevant extent, it's going to be taxed in Oman at the rate of 5%. So what will ideally happen is there is going to be a withholding of 5% on gross. There's going to be a withholding. Then there are deductions available on filing of returns in Oman, which probably could result in tax refunds, which is not emanating out of the WHT, but emanating out of the expenses that you're going to further claim. And of course, there is an elimination per Article 25, which we'll just touch. This question was raised, somebody raised this in the earlier session as well, whether tax exemption for listed securities, which is otherwise available to corporates, would also be available to individual personal income taxes or not. We don't have an answer, but probably the executive regulations probably will throw light on this. Right, so now on the left-hand side, it's an Oman tax resident who is investing in India. And we have two scenarios here. On the right-hand side, you have invested in listed shares, immovable property, etc. And this is sold. Now, what happens is if you really look into the India-Oman tax treaty, this is covered under Article 15.1, 15.4, and 15.5 of the treaty. 15.1 talks about immovable property. 15.4 talks about shares. The primary value of those shares coming in from immovable property. And 15.5 are pure play shares. And all of these are going to be taxed where the immovable property is, either of that or the company which is in that particular jurisdiction, in which case it's India. Yes, sir.
Sir, if he is regarding estate in India.
Real estate.
Yeah.
Okay.
If you sell it, so there is certain exemption that after 2 years, 3 years, if you invest it.
Yes. So
in
there
that
is
case, double tax.
No, so there are certain exemptions which are available under the Indian income tax law, which is section 54. So which means that, if like our primary residence also, so which means if you are going to sell your primary residence and you are going to invest all of that money in a house within specific durations, 1 year prior or 2 years after, then obviously this entire gain gets tax-free.
Sir, the same scenario, what will be the case in Oman? For example, after the law comes.
Yeah.
So now the same year you have not paid the tax. So whether that 5% will be taxable here or.
So this law doesn't have a specific mention as far as I remember in the Oman tax law. However,
I'm talking about double taxation treaty.
Double taxation treaty, you want to.
In the scenario.
No. So ideally what will happen is that, the double taxation treaty talks about incomes and taxes thereon. It does not give you an investment incentive. The investment incentive will ideally come across from the domestic tax law. But if you're talking about the fact that, I will probably choose my domestic tax law, then you're more than welcome to choose the domestic tax law if it's more favorable to you than the treaty.
If I'm not wrong, the law also say about exemption in which the public is interested for social welfare, then I think so this exemption also, it is as good as tax has been paid. The last article is there when...
In the Oman tax law?
In double tax. You have not paid tax. Still it...
No. I think there is a little mix-up. What you're referring to is tax-paying credits.
Yeah.
Now, tax-paying credits are basically the credits that I enjoy, the foreign tax credits that I enjoy, even without paying a tax, because that tax is not to be paid because there are certain incentives available. So let me tell you what has happened is the current, if you look into the revamped Oman India DTAA, which came in July 2025, the tax-paying credit has been eliminated because India does not believe in any of those treaty benefits, which ideally is sham. Okay. So the tax-paying credit, now I have understood your question, that you're talking about a tax-paying credit, which means, as I said, that, so basically this is a foreign tax credit which is available to you without payment of any tax, because Oman ideally has an incentive which does not require you to pay that tax, but still that particular tax you are able to take a foreign tax credit. You are right that you could have happened in the past, but effective 1st of January 2026, this is not possible anymore. Tax-paying credits have been taken out. Right. So, as I said, on the right-hand side, we have listed shares, immovable property, and we get governed by Article 15.1, 15.4, and 15.5, which are the corresponding articles. What happens is that all of these say that, you are going to be taxed as immovable property in the country where the immovable property is situated. And for the purposes of shares, you are going to be taxed in that particular country where the company in which you have invested in has the residence. So that's obviously India. To that relevant extent, since you have sold after 1 year, you are able to take a LTCG. By the way, there is LTCG, long-term capital gains, and indexation. All of that is prevalent in India, which is not there in Oman. But I think there was somebody who asked a question around it also, and here is the tax. However, there is a distinction between mutual fund units and shares. There is a Supreme Court judgment, Dilip Kumar, which categorically states that mutual fund is a completely separate animal than a share. Because, the shares are for companies, whereas the mutual funds, they need to be trusts in order to issue mutual funds. The mutual fund parent will have to be a trust. Mutual funds have not been defined under the treaty thus far, and thus, and that's why it gets into the residual clause of Article 15.6, which says that, this is going to be taxed in the country where the alienator is the resident.
NRE or NRO. In this case, both NRE and NRO mutual fund tax is exempt, right?
Yeah, that's pretty much correct. So to that relevant extent, the mention of NRE and NRO is just a mention, but I think you're right. NRE accounts are obviously tax-free, NRO accounts are not. But I think the emphasis here is the fact that there is a distinction in the law between shares and mutual funds, both in the domestic tax laws as well as the... No, the importance, the significance here is not on NRE and NRO. The significance here is on the fact that, there is a share which is clearly distinguishable, from a mutual fund. The shares are going to be in Article 15.5, and the mutual fund, which is the residual, kind of characterization, is going to be on a residual clause of Article 15.6, in which the alienator, wherever the alienator is resident, in this case Oman, so this is going to be taxed in Oman.
Sir, in your residuals clause, whether cryptocurrency or ETF, that will also come?
Untested, but could, because if you really look at Article 15.6, this is slightly extensive. But then again, it's untested, and because India hasn't really tested it, because India, under the domestic tax law, also has a cryptocurrency taxation. And if you invoke 15.6, assuming the alienator is a resident of India, then also there is a tax. So this is untested, because in both cases, DTL as well as DTAA, there is a tax on the person alienating it.
Sir, it is actual sale or purchase of equity share, or the future option will come under the residual clause?
So the actual sale of shares are there, as I said, in Article 15.5. Futures and options on shares are basically byproducts of particular sale, and to that extent should come within the purview of Article 15.5.
Residual clause?
Yes. No, Article 15.5.
Shares.
Shares. I'll take a pause here. Any questions thus far? Because now we are going to venture out to the elimination clauses. Um, Allow me a little, mind of yours to actually discuss and deliberate this. As you're all aware, the elimination clause is very important because it really talks about the elimination of any taxes that you have paid in a foreign country, correct? So ideally what happens is if you're a resident of India and you derive income which is taxable in the Sultanate of Oman, you get a tax credit in India for the taxes which is paid in Oman. However, it's limited to the Indian tax on that income and vice versa in case you are a resident of Oman. Let us try to understand this. However, at the beginning, let me caveat it that the executive regulations are not in place. We really do not know as to what mechanism of FTC or foreign tax credit the executive regulations are going to put forward. However, what we have done is the case case 1 talks about the proportionate method, which is a generally acceptable method in all geographies across the globe. Case 2 method is per se the method which has been prescribed under the corporate income tax law. So I don't know which is going to happen, but I thought I will extend this elimination mechanism through an example qua both the methods. So let's understand that I'm filing a tax return in India and my taxable income is 30 lakhs. This is INR. And the total taxable income is also 30 lakhs. I pay a tax on the slab rate, which is 480,000. There has been a withholding on me, which is 350,000. Ultimately, the net tax payable is 130,000. This much, all good? Perfect. Now let's talk about the tax return in India. So this is obviously I'm a tax resident of Oman, and to that extent, this is included in my global income, and hence to that extent, I need to pay taxes thereon. Assuming for both in of case 1 and case 2, my taxable income is 45,000 riyals. And the corresponding, I have used a conversion of 228. Don't please question the conversion rate because it's just example. The taxable foreign income, which is 30 lakhs, is 13,158. So the total income is 58,158. Threshold, which I have deducted 42,000, which is the threshold for arriving at a taxable income in Oman. And to that extent, my net taxable income cases is 16,158. Tax thereon is 808 at the rate of 5%. Thus far, no problem. Now let's try and understand what FT do I get in case 1 and case 2 separately. Kindly look at the right-hand side of your extreme right. We are talking about actual taxes which are paid in India, which is 2105. I have used the same exchange rate. Right? Tax credit which is claimed in Oman, and we are going to talk about how we arrived at 183 and 658 under the two different methodologies. The excess tax, which is 1922 OMR and 1447 OMR, dies here. Sir, that's the answer to your question, that we cannot get anything more out of a foreign tax that we have paid. So all of these guys, 1922 and 1447, dies here. There is no carry of this. Okay. So the credit mechanism in case 1, as I said, what I have used here for the purposes of this computation is the proportionate method which is used globally. So what we'll do, the FTC is going to be 13,158 divided by 15,158, which is the total income, multiplied by OMR 808, which is effectively coming 5% of 16,158, and what I get is 183. So that's what I've put to case 1. Right. Let's move to case 2. Case 2 is the one which has been enshrined in the corporate tax provisions of Oman, and hence I don't know as to which all between the two whatever is going to be in place. This is only to drive home the point that you are not being able to be kind of richer because of the fact of that you are able to use this FTC. You cannot get richer. But the whole point is case 2, the Oman Income Tax Act suggests the following mechanism for an FTC. That's the Corporate Tax Act. So your OMR, you just put it to tax. That's 808. It's similar, which let's call that A. What I have to do is I need to subtract my foreign income from my total income. That's what the corporate tax law suggests, that you need to put aside or set aside the foreign income from the total income. That leaves me a balance of 3,000. I apply a 5% on, because that's what the Oman corporate tax law also suggests. You apply a 5%, that's 150. So basically is that, 150 is going to be net tax payable. How do I write? Is basically 8 minus 150, 68 is your.
See, in India, I sell a residential property. I make a profit of say 10 crores. But that gets exempted because I invest in another property. So is this 10 crores taxable over here, or it is just taxable income which will be taxed over here like zero?
So that's a very good question. Obviously, we would need to depend upon the executive regulations on that. But, just to drive home the point, what ideally happens is, obviously, you are a tax resident of Oman. To that extent, the global income gets taxed. So ideally, in all fairness, my view is that you need to show this income here in Oman, and in the absence of any incentive which is available in Oman, this should ideally be taxed in Oman.
Okay, thank you.
Of course, we need to see the executive regulations in case these incentives that is available back in India can actually make the tax in Oman zero. But that's something which can only be thought through at a later point in time.
Yeah, but here you have mentioned taxable income. See, you are saying taxable income over here.
Correct.
So taxable income means after exemptions, right? So what is taxed in India?
No, taxable income is gross. That's what was told in the earlier session as well. Taxable income is gross.
Okay.
The specific definition which the Oman personal income tax law gives, which ideally the taxable income is gross, from where various exclusions, various costs, various exemptions are to be taken.
Okay, thank you so much. Thank you.
I'll still pause for.
It's with reference to a source,
Yes.
That means whatever income there I am showing.
Yeah.
And whatever tax deductions have taken with respect to that income.
That's correct.
Is
yes.
only adjustable.
That's correct, yes. So it is source driven. Right. So I did mention about the India-Oman treaty, the one, and this is very important for all of us to take note. That's because there are quite a few changes that's there in the treaty. Like for instance, somebody asked me a question, tax-paying credits, that's gone. There is a in the royalty and the FTS rate 15 to 10 is what we talk about. There are exchange of information norms effectively, which makes things a little more for exchange of information between these two countries. There is a tax recovery assistance which both India have given each other. So which ideally means in case there is a tax payable in one country, around that ITCC or income tax clearance certificate and just vanish, that's not going to happen anymore. So the tax recovery assistance, both these two countries have agreed that there is going to be a specific tax recovery assistance. The bigger point is that there is no MLI or multilateral instrument relationship between India and Oman, but that particular treaty which has now come in across is action plans, BEPS action plan compliant. So ideally, there's no, this is compliant shopping as well. This includes a principal purpose test, it's very important, which empowers the tax authorities to deny treaty benefits. So as you are aware, it's the domestic tax law, the treaty, whichever is more favorable to the taxpayer prevails. But how is going to be denied in case the tax authorities think that there is an attempt to unduly put in inconsistent provisions to the treaty, which is sham in nature. So this ideally follows the general anti-avoidance rules as well. I don't want to talk about the relevance of that treaty. We all know how a treaty is relevant. Return filing considerations in India. I think, I was trying to get all of you guys, this is more of a recapitulation than anything else. Don't forget to monitor your annual information statements. Don't forget to claim TDS the incomes that you are offering to tax. Is their own needs taxed, claimed. Nothing much here. NRI's income tax filing checklists, nothing much here. Excepting for the fact that, during the course of my consulting have found that, Form 16 is individual, wherein the part salary has been paid in India and part salary in a foreign jurisdiction, ignored at times. Part year worked in India, part year worked in foreign jurisdiction, Form 16 salary withholding taxes get ignored. Tax filing keynotes, I think we can just to remember that, this year it's September. Date for filing tax returns in India is 30. And for us, it's going to be ITR 1 to ITR 4, which is going to apply. In all fairness, it's ITR 2. So this is the impact of the Indian business operating locally. Please remember that there are two sets of compliances which are going to hit you. Number one, it's going to be withholding taxes on salaries. Number two, it's going to be withholding taxes on contractual payments. And the contractual payments are different between resident contractual payments. For a resident, so there is a withholding of 1%. For a non-resident, the withholding is 5%. For a resident, there is a threshold of $20,000 available. For a non-resident payment, in my view, with the reading of the law, which is in Arabic, I understand that there are no thresholds available. Okay, which means it's from DL1. So obviously, what happens is that this embarks a lot of challenges now on the accounts, on HR, on the company itself, because what will ideally happen is because of you need to understand what all salaries are going to be taxed, what all benefits are going to be taxed, and what all exemptions can enjoy. Reassess expat corporate tax, expat taxes. What happens in the globe? You get tax equalized. To say you can't be worse off, because of the incidence or the introduction of a tax than you were before. So, which means ideally that all expatriates they get tax equalized in order to ensure that the tax which is actually put to a later point does. So, all of those tax equalized have to be built up for all expatriates. Net to gross salary arrangements, what will ideally happen the moment you go, you are as the employer, you are bearing the taxes of that appears as a perquisite in the hands of the employee. And to that extent, that perquisite will also have to be taxed, for which a separate valuation mechanism will be put to place. Permanent establishment, we need to be very careful about how do we really want to structure our contracts. That's because the interplay is between in case there is a salary which is at the home country levels and at the host country levels, this ideally becomes a scenario in most cases wherein this is permanent establishment, or at the very least, these raises applications on permanent establishments. So clearly, in case there is an agreement, then we have to clearly define who is the legal employer versus the economic employer, and to define risk and responsibilities that can be done in geography, as I said. Otherwise, there are, and this takes time. Transfer pricing cross-border income, of course, there is no transfer pricing in Oman thus far. Generally, of course, the MNEs which are subjected to DMTT are transfer pricing applicable, because the FANIL is transfer pricing. There is a tendency in this kind of happens of transferring dividends as salaries. I don't know how much it happens, but there is a tendency. That's because salaries do not get taxed, and those salaries appear as a tax deductible expense, and to that extent gives you tax shields. So if you are going to in salaries which are not taxed as instead of dividends, then ideally what happens is still I understand that there is a fair bit of leverage between a 15% and a 5%. To that extent, this might still go on, but in tax mature jurisdiction, these are known as constructive dividends and are disallowed. So we need to be slightly mindful in case we were to still do this. Employee secondment concessions, we the short stay exemption, and we spoke about the monitoring and the to structure this. Be careful about permanent establishment. This is very important. We need to modify the module to account for the personal income tax. We need to also put to place a proper AP system which talks about the withholding from a contractual perspective. We have to align declaration forms to capture global income. I don't know whether the executive regulations are going to debar the employers from giving credits for DTAA claims, but in case they do allow, then there would be declaration formats and procedures to capture global income for the employer, to capture DTAA claims, and to capture the residential status. At least tax mature jurisdictions do have this. Of certificates for later point in time, and the tax on are important issues that needs to be talked, that needs to be spoken now. Cross-border compliance and reporting, this is something finance teams and the AP team need to be monitoring. I think now is the time, as Gauravji also mentioned, that now is the time that we could probably start an impact assessment of payroll, grade-wise, structure-wise. It could appeal to the highest structure, and gradually it can come down, but it's very important that we understand the impact assessment of the payroll, more importantly in case we want to do tax equalization in our policies. No, there's a fair bit of work, so the employer would have to ensure that the expenses that's due to him gets deducted, the exclusions that are due to that particular person gets deducted, and then you could yeah. So global incomes, we need to see whether this is allowed, but in various countries, there are a possibility of global incomes being included. But in most cases, my assumption is that in case you want to talk about a global income, you will probably have to file a return yourself. You might be an? Correct. Correct. Yeah. So the law thus talks about that as an employee, you might go across to your employer. If you do not have any of income, the employer can deduct salary and also file returns, if I remember the law correctly. You can also file returns. Now the whole point is how far the employer is going to go, or the executive regulations are going to allow the employer to go. It's a matter of debate. However, let me tell you, in India, generally what happens, you can talk about the various deductions. You can talk about, what kind of incomes you're going to have. And, for a limited other incomes of yours, the employer the employer could deduct withholding thereon as a part of the general section 192 that they deduct. But it's a matter of time. It's a matter that, is best put to in the executive regulations. I think we have already covered this. There's nothing to be covered. Maybe we could give ourselves a minute, 8:54. Let's wait for a minute if there are any further questions. What? Dividend.
Sole proprietor as well as partnership article. Dividend.
Why would you declare a dividend in a sole proprietorship?
Article. So that is the article of dividend from limited company.
That's a good point. So what, in our consultations with the OTA, we might put this across. Is it somewhere? I'm not too sure because, okay. Ideally, in all fairness, why would a sole proprietorship will declare a dividend, for all you know? In my 28 years, I've never come across an opportunity of a situation wherein this has been done. Jay?
Yeah, Yeah, first of all, thanks for the presentation, very informative. You took the DTA in detail, that was interesting. Just a scenario where, like in India, we have Hindu undivided families. So there is a declaration of personal income tax. How in this region, these Omani families will do the filings or how they will do the declarations?
Right. Of course, the filing, has not been covered thus far. But I think, if you're talking about a specific arrangement like a Hindu undivided family, those kind of tax incentives have not been put to place in the law thus far. So, the law is pretty silent on these kind of benefits, wherein you probably share your, or you get an extra entity for, for the exempted amount. So, if the question is that I could probably create an HUF and add on extra 42,000 riyals, that particular scenario has not. If that is the question.
Yeah, and in this part, we see how big are the families. So probably tax authorities will have to look into this scenario specifically.
Yeah, very true. I agree, but the whole point here is that these might not be relevant for a family unit as a whole. I do agree to your point that all of the members, individual members of these families might be up for, kind of Oman PIT, because all of those are pretty rich individuals, high net worth individuals. They would be themselves. But, there are other ways and means of doing things, So in Oman, people are doing Cyprus trusts.
Yeah. I think let's have questions now along with the food. And then I will request our Vice Chairperson,
Sir, in
C.A.
tiebreaker
Sakithaji.
rule, you talked about permanent residency, the tiebreaker. Sir, can you throw some light on it, sir?
Sure. Oh, can I have the presentation, please? Ma'am. See, tiebreaker rule ideally happens when, you kind of become a tax resident of two jurisdictions. And both jurisdictions ideally claim that, you are a tax residence of their tax residency of theirs. So there are various conditions fulfill seriatim. So which ideally means condition 1 is first, condition 2 is second, and the interplay, now I think I get that. Right. So, what happens in case there is a tie, what happens is the country in which you, so for instance, so good question. If you have your own home in India and you have a leased home here and you probably, kind of divide your stay between the two, then I think India will get precedence.
Yeah.
Yeah.
I think rest of the questions we can take it after dinner.
So thank you, ladies and gentlemen. Thank you
thank you, C. Asrujit. Now it's time for vote of thanks, and I'll invite our chairperson too.
So just bear with me for a minute. I'm not going to take a long time and be in between the food and yours. So it is my honor and privilege to deliver the vote of thanks for such a timely and insightful session, understanding of the Sultanate of Oman's personal income tax. At the time when the concept of personal tax is just being introduced, this session is like a platform for knowledge sharing. It's not only for the professional community, but as well as for the residents and citizens, so that they can understand the implications of the tax and also plan accordingly. So we are deeply grateful to His Excellency, Mr. Venkata Srinivas, Ambassador of India to the Sultanate of Oman, for joining us this evening as chief guest, as well as Dr. Abdullah and Mr. Mustafa for their presence today. A heartfelt thank you to the keynote speaker, CA Piyush Chhajed, Central Council member, for your enlightening words and guidance, which has added a great value to this session. We sincerely thank our distinguished technical speakers, CA Gaurav Kapoor, the partner of PwC Oman, and CA Asrujit Mandal, partner BDO Oman, for delivering an engaging and comprehensive analysis of the personal income tax of the Sultanate of Oman. A special word of appreciation goes out to College of Banking and Financial Studies, CBFS, for their continued support and collaboration with our chapter. To all the members and the guests who were present here, thank you so much for your active participation and making this event a great success. And also, I would like to finally thank the Intercity Hotel team as well as the AV photography and videography team, and also the dedicated team of volunteers for ensuring the smooth functioning and conduct of this event. So let us continue to learn, lead, and evolve all together. So once again, thank you and have a lovely rest of the evening.